We generally have around 50 to 80 people
Okay.
on average. Okay, so let me start this session. Good morning, everyone. Very warm welcome to all participants. I'm Aditya Agarwal, ThinkTank Multidisciplinary Global Platform Chapter Leader. Welcomes you all to ThinkTank Global Conclave, covering in detail IBC think tank, financial think tank, capital market think tanks as a major part of think tank Vivek Patra. Vivek Patra. Vivek in Sanskrit means knowledge and wisdom. Patra is a innovative news updates containing slides on sharing latest development and real life examples, which are provided by CEOs, CXOs, CFOs, specialists and professionals with good experience at global level. Today we have Think Tank Disciplinary Global Platform special meeting for all stakeholders in finance, corporate affairs, industry, and professions. Think Tank has been in existence for over decades. This idea was first thought about on 6th of January 1991. That was mainly to have conferences, conclaves with CEOs, CXOs, CFO, panelists, specialists sharing their experiences, real life examples. Our panelists are finance leaders working in reputed companies or professions since many years and have deep domain knowledge. Think Tank platform now on digital platform has got overwhelming response globally on digital medium and expanding rapidly through LinkedIn and Facebook. Our participants and experts have rich experience in industry professions who are having good reputed qualifications like Chartered Accountants of England and Wales, CPAs, CFA, CFPs, IMs, CAs, CS, CMA, ESA, DISA, FRM, IFRS, BTech, Masters, PhDs. They all come here on this platform, sharing their experiences, knowledge, wisdom, and spread as a reach out initiative globally. And in spite of limited resources and the time they have, they come on this platform and share their experiences. Due to overwhelming response to our annual report, corporate strategies, ESGs, we have announced 5 key awards and recognitions. It's about profit, people, planet, professional platforms. For corporate annual reports, analysts, professional achievers, CEOs, CXOs, CFOs with a very reputed jury with rich experience in the interactions and shareholders and boards. These recognitions and awards would be announced with a rigorous process of scrutiny and choices and interactions with the participants and would be given digitally. And if possible, we will hire a well known or well located auditorium in Mumbai and have this event. As participants are aware, recently we have launched a much awaited referrals appropriately titled as Think Tank Vivek Patra, India Growth Story, a comprehensive conference material compilation of over 600 pages, sharing experiences by CEOs, CFOs, CXOs, and specialists with their latest development. And this includes different areas like blockchain, regulatory, fraud, in financial reporting, Indian accounting standard, IBC, taxations, portfolio management, digital, capital market, and others. We also we will also be covering important and latest development as suggested by many participants in coming weeks, and such are like valuation and financial modeling, health as well, cybersecurity, blockchain, MSME, etc. We request all the participants to subscribe to Think Tank YouTube channel, wherein you can find all the summits and conclaves whenever you want. Based on your flexibility of time, you can just go and have a look. We once again welcome all members and panelists. I especially thanks my colleagues in digital media, Anupam, Ajay, Anurag, and others. Today, we have an excellent think tank disciplinary platform seminar, eminent stalwarts and specialists sharing experiences and latest developments. Let's have an interactive section. Thank you so much for joining, and I hand it over to you, Nupur.
Yeah, thank you, Aditya, and thank you everyone for inviting us. I represent my organization, Prabhudas Leeladhar. With me today, I have my two Siddharth. Siddharth is a CA, CFA, and he's currently also pursuing his CMT. And I have my Shilpa, who takes care of our derivatives, will be covering the second part. Before we start the session, I would also like to congratulate everyone on 75th independence, and really great to be part of India growth story. And we all have been part of capital market, so we have really seen the growth, how the capital market does. As a subpart today, we'll be covering one of the features of our portfolio management offerings, which is completely unique of its kind. So first offering in Indian domain, where it is a complete quant-based tactical asset allocation, PMS, purely focusing on asset allocations, and at the same time how industry will shape up in years. This is very much from what the Western countries are currently doing, and during our presentation we'll explain you that how passive investment is taking over the active investment and what the global trend is all about. And we as Prabhudas Leeladhar, being in this business for more than now 7 decades, we have always pioneered ourselves with new offerings, newer kind of initiatives, which we believe, in fact, we were the first broker that started first ever digital contract with the net rate and gross rate, which was very difficult that time to implement. And none of the brokers ever wanted to have a net rate versus gross rate kind of. So we are always leaders in industry in taking the first step first. And my colleague Siddharth and his team have taken an excellent initiative of developing this product for working for more than 3 years in-house. There are a team of more than 16 people with economists, with CAs, with program developers, few of them working overseas. During conversation, I'll be also participating, but since this product is completely developed by Siddharth and his team, I'll hand it over to Siddharth to take it forward. And if you could allow Aditya, Siddharth, or me to share the screen, then
Yeah. So I just wanted to give one more information. This we are live on YouTube, so some of our viewers will be on YouTube. So in case we have any questions from there, we'll try to bring that here on this platform. So that I made you co-host. You have the right to present it. So please go ahead and do that. Thank you so much.
I would like to share the.
Manoj, your voice is too low. Maybe you may have to come closer to speak.
I would like to share. Has been a part of the ThinkTank.
Apologies, Manoj. I think your voice is still not very clear.
Can you hear me now?
You can try. Not that great.
Yeah, I would like to share a few thoughts about.
Perfect.
Nupur Patel has been a part of ThinkTank since over 9 years. If I remember correctly, 2012, we had a roundtable on latest developments of the corporate.
Yes.
Short notice, there was a development which came on the headlines in the pink papers. It was related to forensic issues in the commodity market. The company, which ultimately became a scam, which was clarified, and we discussed the FIR story. FIR in markets, we talk about first information about the markets, which is supposed to be notified on the stock exchanges as per regulations. This was a different type of FIR, right? First information report, which was filed. And since those days, we have always been doing deep dives. Deep dive into latest issues, latest developments on the market, finance, corporate affairs, industry, worldwide. That company at that name, the name was Financial Technologies, right?
Yes.
Now, the moon, something called
36 moons.
63 moons.
Yeah, 63.
Has been a major software provider to the Bombay Stock Exchange, also a very successful platform. So a deep dive was done, and we have had several fund managers, topmost CFOs, CEOs on the platform today, and highly qualified people. I would like to acknowledge Nipur. Siddharth has come. In fact, yesterday Shilpa was telling me, Siddharth, a young professional, 30 years old, dynamic, a continuous learner, a person who is a go-getter, and so many qualifications also from London, University of Warwick. The presentation you sent talks about business excellence, and so lots of expectations. Let's make it very interactive. We have several stalwarts like Somani is here, Manish Sangvi is there. Each of them is a speaker in their own right, in their own common. So, learning some more, and everybody is welcome to bring guests also and contribute in an interactive way, positive way about the India growth and lots of innovations happen and how everybody can profit from the disclaimer.
Thanks, Manoj, for your kind words, and we really appreciate and looking forward with you guys. It's wonderful. We have been associated for many, many years. And now, in the interest of time, I'll request Siddharth to take it over, and I'm always there. So I'll also be interacting during the course of conversation. Over to you, Siddharth.
Thank you. Thank you so much for the warm and kind words. Today, I will be talking about an important topic for the discipline of finance and investing, and also a product that we've put in 3 years to develop. I think it should be of interest to everybody also to understand the importance of asset allocation and how asset allocation can be effectively used to manage your money and create wealth over the long term. While doing this, I will also be showing you all the product we have developed that will make you do this very easily. So under the portfolio management services license, we have launched a product called multi-asset dynamic portfolio. So the name itself specifies everything that one needs to know about the strategy. First, we understand that this is a multi-asset product, which means it doesn't have exposure to equities only. It has exposure to many other asset classes. Why we have that exposure and how we do it is what I'm going to take you all through. The slide here that I'm talking about shows us how important asset allocation is to the overall scheme of things. So the cult in India usually talks about equities and how important stock selection is, market timing is, and being in the right stock is. But the data suggests otherwise. So this is a globally used research study that does a return attribution to its source, which means if 100 rupees of returns are generated over a decade or 2 decades, what is the contribution of each factor in actually getting those returns? So this tells us that 91.5% of returns are coming from the decision of asset allocation, which means if I'm in the right asset at the right time, most of my job is done. But if my asset allocation is wrong and then I pick the right stock, it's still not good enough. For example, for a short or medium while, recently during the COVID crash, everybody knows Bajaj Finance is a phenomenal company, the leading and highest margins, highest ROEs, most efficiently run, and the most tech-enabled, data-driven NBFC in India as of now. So from a security perspective, it's a AAA stock. But during the COVID crisis, we even saw that Bajaj Finance went down from say 4,800 to 1,800. So was my security selection wrong or was my asset allocation wrong? So the question is about being in the right asset at the right time. If you do that, then you're going to sail through the market cycles very easily and with very little stress of capital erosion. Coming back to my point, the contribution of security selection is only 4.6%, which means it doesn't matter so much as to which stock I'm in. Till I'm in the right asset class, my returns should flow in. The next one is about market timing. So market timing is a very, very debated and controversial topic, with most stalwarts have given up on the concept of market timing because it's simply impossible. And rightly so, because market timing only contributes 1.8% to your investment returns. So this is the broad premise with which we've started our research to understand how we can do asset allocation more efficiently than rest of the people. Further, to solidify our thesis, what we would like to share is a snapshot of the returns of the different asset classes from 2007 till 2020. This is a very simple, intuitive snapshot, and it tells you all that yes, 2007 was an excellent year for equities. So an equity investor would have been running to the banks very happily. We see large caps giving 47%, mid caps giving 69%, small caps giving 94%. And that's all very good. But then come to 2008 and you've got a complete wipe off of your equity returns, which proves the point that a single asset approach is A, very risky, B, very volatile, and C, not advisable for sustainable wealth creation, which is why we've stressing so much on a multi-asset approach to portfolio management. An equity-only fund manager has a mandate to only buy stocks. Even if the markets are looking bad or the outlook for economic growth or valuations is bad, he still has to buy stocks. But with a multi-asset mandate, if equities as an asset class is not looking good, I can move to gold, I can move to corporate bonds, I can move to international equities, I can move to liquid funds, I can move to government securities, which means the flexibility with which I can protect my investors' capital, manage investors' capital, and try to grow it consistently, the flexibility is much higher. And this is why we stress so much on an asset allocation strategy. Within asset allocation, we focus on passive instruments only in order to eliminate security selection, sector selection risks. We have gone with a complete quant plus passive approach. So our methodology is based on quantitative research, but we deploy money into passive securities. By passive securities, I mean index funds and ETFs. Buy any stocks or sectors or a basket of stocks or sectors. And by passive, I mean, if I want exposure to large cap, I will be buying Nifty 50 ETF. If I want exposure to mid cap, I will buy a Nifty mid cap ETF. If I want exposure to bonds, I will buy a Bharat bond ETF. If I want exposure to international securities, I will buy the S&P 500 or the NASDAQ index fund or ETF. This data is only proving my point that in 1998, the ratio of active to passive was 89 to 11%, which means almost 90% of the money was managed actively by fund managers. Come to 2019, that ratio is at 50-50. The latest data trends, though not released officially, suggest that passive is now 72% of the total US AUM, active and quant being another 28%. So this is a huge global trend that we are seeing, that people are choosing low cost passive instruments as their investment vehicles rather than trusting active managers to manage their money consistently and try to generate alpha over a long period of time.
Siddharth,
yes, please.
we make it interactive right from the beginning. Few wonderful slides shared by you. It really shows a deeper study done before launching your scheme. Now, looking at the asset allocation returns, it is very clear. The previous slide showed, although you mentioned NASDAQ is the biggest winner just by a few percentage points, but the gold, which most of the Indians across the length and breadth of the continent has performed exceedingly well, not only in 2020, but across for the last 10-15 years. Among the best asset class on a conservative investment basis,
Between 2014,
no brainer.
2013, 14, 15, gold has underperformed, sir, severely underperformed.
No, we are aware of that. Markets also, there has been lot of volatility.
Exactly.
24% minus, 24%, 42% minus, but excellent return of about, I think, 16% cumulative, right? Year to year in the last 15 years. Another
Right.
thing is a technology trend, especially Nasdaq. This year, excellent returns. Pandemic was there, worldwide impact. Incidentally, who benefited from the pandemic? It is the technology companies.
Absolutely.
Some of the innovators who are there on Nasdaq. So Nasdaq
Absolutely.
a trend in the pandemic year, in spite of very low GDP growth worldwide, particularly last year. Now is on a smaller base. Maybe GDP is higher in US and here also. So it shows gold. Without thinking, one can put allocation in gold. Another thing is Nasdaq is leading that trend. While equity, large cap, mid cap, small caps, we were having a discussion some time back. Most of the top mutual fund managers, I'm talking at a CIO level, with around 30 years experience, some of the top names, they seem to have missed the bus. In fact, some of the stocks, like the metals, somebody said yesterday, a CIO of a top 3 mutual fund said it has gone up 3 times, but it may go 90% in the next few years. They have missed the cycle. It's a very difficult game where lots of data is very essential. The deep dive into stocks and asset allocation, it is the returns is a very eye-opener, the way you have said it.
Yes. Thank you.
So the next slide, you have shown the trends globally. We talked about particular US equity funds, passive investing, active investing, and what the funds can do. And this. I hope you also have similar data about Indian, where the percent of assets in the Indian equity. I wonder if that data is available.
It is available, but in India, this is still nascent. Usually in asset management, we do follow Western trends. And for those reasons, the Indian data also, of course, there is a huge move to hybrid and passive funds over the last 15 months. But the data is still showing a trend of increase, but it's not reached the 50% mark. We've gone from around 7% passive to 21%. So it's a huge jump. But to reach the 50-50 mark, I think we're still a couple of years away. But I believe the next decade will be dominated by passive instruments, smart beta instruments in the asset management space.
Siddharth, we have a question from Mr. Milan Shah. If you would like to take, or no worries. He is asking that can we elaborate more on our quant approach? So that's something for.
Yeah, so I would reach there
Exactly.
organically.
Spend a lot of time on quant approach, lots of time. This is a main innovation. Now, Siddharth, I would like to have your views on certain asset classes. In the last few months, I have done a little traveling across Maharashtra and also talking to some of the people in the villages. What is their thought process about money? Even people who don't need English. And when I asked them about Demat account, they said, yes, we know about Demat account.
Right.
About an asset, they know about gold. They are ready to open Demat accounts. They are ready to invest if opportunity is given to them.
Right.
And they are also creating gold. As of now, they are buying physical gold.
Right.
Which, of course, there is a safety issue. And the financial markets, I feel from the interaction, there is a possibility of multiplication of investment opportunities in India in various asset classes, including the funds, including funds, innovative funds, where actually the it can go up by 10x in the next 5 years, I feel. I would like you to share your thoughts about particularly gold as an asset class, how much percentage one should put, and how much percentage one should put in innovative funds. with a low cost.
Right.
We'll
Then
do that, Manoj, during our conversation. Let the flow go on. Let Siddharth complete the flow. And I'm sure that during that, all this question that you have, because we have a separate allocation table also to each and every asset class. And we have shown that how that separate allocation table, what kind of returns those allocations have given in the various years. So let us go through the slide. We'll get that question, answers to your question. Yes, Siddharth, continue.
Yeah. So I think I'll take one question immediately about how much allocation should be made to gold. So ideally, we do not follow a strategic asset allocation model where we decide fixed exposures on any given point of time. We follow a tactical asset allocation model. In a tactical asset allocation model, the focus is to be in and out of asset classes using tactical opportunities. So our data suggests which asset classes are providing tactical opportunities based on risk reward. And based on that, we decide if we want to go overweight or underweight on a certain asset class. For example, in February 2020, we had reduced our exposure to equities to only 18%, which means the entire COVID crash was something our portfolio never saw because we didn't have equities in our portfolio. We were overweight on gold and fixed income. Ideally, gold as an asset should be used for one of the two reasons: a hedge against inflation and as an instrument to protect against a weakness in the equity markets. So I would only buy gold in any asset or in any portfolio, either to hedge my portfolio against an ensuing risk or to hedge against the risk of inflation. So if equities are looking bad, that is when you consider gold. Otherwise, a standard 8-9% allocation is more than enough. In extremes, we go up to 25-30% also. But as of now, we are at a 19% mark in terms of our gold allocations. Now, coming back to asset allocation and how we go about it very quantitatively, I will take you through the 3 pillars of our strategy and how we are doing justice to them. So the first thing we want to do is protection, which means a priority is not first on growing your money, but it is first on protecting the capital. If we are able to manage risk and protect your capital during the vagaries of the market cycle, then we get enough opportunities to participate in secular bull markets. And therefore, participation or upside participation becomes our second focus. And our third focus is using the quant methodology to deliver consistent performance, which is unbiased and has no human emotions driving decision making. And that is what is the difference of a quantitatively driven investment approach. Now, what are the 7 or 8 things one must understand very, very clearly to understand the strategy? First is we invest across 7 to 8 different asset classes versus a traditional long only equity, which only invests in equity as one asset class. As you all have seen, an equity only approach, while great over a 15-year period, gives you the 3 or 4 very, very harsh periods in between. Excuse me, gives you a very harsh period in between. Secondly, tactical asset allocation, as I've already explained, is extremely important. Strategic asset allocation focuses on risk profile of investors. Tactical asset allocation focuses on risk management in the investment portfolio. And therefore, we want to provide opportunities to investors to participate in a risk managed portfolio rather than a portfolio that is driven by their risk profile. Now, in the Indian PMS domain, we are the first of a kind quant-based multi-asset fund, because usually we see discretionary fund managers who use their experience and wisdom and fundamental analysis to make investment decisions. Also, I have explained that we only invest in passive instruments via ETFs and index funds, and therefore we have no stock or sector selection. Another important point to understand is about the availability of multi-asset mutual funds. So as of now, in India, we see a lot of multi-asset mutual funds, but because of the size and regulation of mutual funds, they do not have the kind of flexibility that one must expect in a purely tactical asset allocation strategy. Because of tax constraints, they have to maintain a 55% minimum equity exposure to qualify as an equity scheme. And if they qualify as an equity scheme, they get some tax advantages. As a PMS, we do not have those restrictions. And for those reasons, when we do think that our outlook on equities is weak in the short to medium term, we take radical shifts to reduce our equity exposure from 70-80% to 15-20%. Such kind of shifts are not possible under a mutual fund gamut, and therefore we specialize in a tactical scheme where investors truly get an asset allocation experience rather than a 50-50 kind of strategy. Nupur bhai, you want to take this one?
Sure, Siddharth. So probably see what is very important to understand is where one takes exposure, because the key to any investing or the success of investing is more about the asset classes and the sectors where you take. So probably when we developed this strategy, or when our study was going on, first we decided that what are the asset classes, and going forward we are doing deep study with our team. We are going to add lot of new asset classes also. Currently, we have G6, we have corporate bonds, gold, equities, and liquid. Definitely, we'll have multiple asset classes in a few quarters or years to come. So when we decide that we would like to take exposures to the equities, and within equities also there are certain meters which are proprietary developed by Prabhudas Leelathan. We'll be taking you through those meters. If we decide that we want to take exposures to equities, then we have a large cap, mid cap, and international equities. So it's not only about investing in equities, but also taking an international exposure, which Manoj very rightly mentioned earlier, that last year probably most of the tech companies gained. And if you want the exposures to the tech companies, then NASDAQ is one of the best place, because that has the global. There are no other indices in the world or probably exchanges in the world which represents the major global tech giants. And that exposures can be very well taken by NASDAQ. Probably our gold represents by Nippon India Gold Bees, then corporate by Bharat Bond. And for G6, we have Nippon India Long-Term Gilt. And obviously the liquid funds, when we don't believe that we want to park any money either in any of the asset classes, then obviously we go for the liquid. And for Indian equities, our exposures are always taken by Nifty Bs and mid cap. So the reason of selecting ETFs or an exchange fund was very simple. We wanted to eliminate the sector specific risk, stock specific risk, and more importantly, not being biased towards a particular, say, metals or any other sectors, because when trends are going, fund managers are always tempted to take higher exposures to a particular asset classes to create alpha. But when we know that when we are taking an exposures via ETF, ETF represents the strongest companies by market capitalization for that particular. So if I'm taking exposures to large cap, then I know that Nifty will represent the top 50 market cap companies by India. And I do not have to bother if particular sector or a stock not doing good, automatically it will be replaced by another sector or stock. And we have seen that n number of time in past. So there are a lot of examples where the weightages of BFSI going high, or probably weightages of IT coming up when the IT is doing good because of the market cap, or within BFSI, we have seen the stocks like Yes Bank moving out and HDFC Life coming in. So this is the biggest advantage of taking exposures by ETF, which itself eliminates a lot of risk for the investors. And that gives the protection to their wealth, because ultimately the CAGR returns of all exchange funds and the ETFs are always going to be far superior in years to come.
Great. So here we broadly explain the rationale for having each of the asset classes in the portfolio. I will take you through this in a minute. So domestic equities, of course, giving us an emerging market equity exposure. This is for growth. And because we're using the mid caps and the large caps, we automatically get diversification across sectors and industries. As Nupurbai already mentioned, that we are getting the entire listed universe, which is market cap weighted, irrespective of which stock or sector does well, the index should do well because the participation keeps changing. So in up to 2014, we saw pharma was a dominating sector, which cooled off for the next 6 years. After that, we saw BFSI and consumption being the leaders. Now we are seeing IT and metals also participating. Irrespective of which sector participates, we do see that the index grows as the exposure of a certain sector in that index grows. And for those reasons, domestic equities form a very integral part of our portfolio. We add fixed income securities, both long and short duration, to bring the stability and capital preservation aspect, along with a kind of steady income aspect. We only invest in AAA securities. Bharat bonds and government securities are actually both backed by the government of India and therefore have a practically zero credit risk. And it's important to understand the difference between long and short duration and how the interest rate cycle has an impact on which asset class we select. It is not a very simplistic decision that we can take, that we can always buy government securities or always buy corporate bonds. We need to manage our duration in line with the interest rate and the monetary cycle. And in our quantitative model, once I take you guys through that, I will explain how we manage duration in the fixed income exposure. US equities, of course, giving us the world's largest GDP exposure, giving us a geographical diversification, exposure to the fastest growing tech companies, also giving us a different dollar asset and exposure to USD, which is appreciating against the INR. And therefore, US equity is an integral part of the portfolio too. The next thing is gold, which is considered as a safe haven asset. It is negatively correlated with all other asset classes and serves as a superior hedge against inflation. So along with all these reasons, having these four broad buckets of asset classes becomes very integral in managing the risk at a portfolio level. Usually, even if the market falls by 20-25%, we don't see our portfolio correcting by more than 3.5%. So that's the kind of stability we are talking about. And in up cycles, we do participate upward of 40-50% also. So when I discuss returns, I will take you guys through this also. This is the most important part of our strategy. This is the quantitative model that we have built to be able to do effective asset allocation. We have built 9 meters. Each meter represents an important parameter that has an impact on asset allocation, that has an impact on asset class cycles, and within asset class cycles on inflection points within asset classes, which means I want to capture change in regimes. How do I capture change in regimes? Of course, 1 or 2 parameters alone are not enough. Therefore, we've identified 9 parameters or 9 factors that can help us capture this change. I will quickly take you all through each of these. The first one is economic cycle. To track the economic cycle, we have built something called macrometer. This is our proprietary quant tool. The macrometer uses 25 different indicators. The output of the macrometer tells us the economic regime and direction that we are in. For example, we could be in a phase of strong growth or steady growth, deceleration, recovery, or slowdown. Based on this, the macrometer gives us a guidance on asset allocation as per the macro cycle. But we cannot only take the macro cycle because in the short term, macros and markets do diverge significantly. They only converge in a very, very long term. And therefore, we need other factors to support our decision. So So we look at the next one, the monetary cycle. The monetary cycle is captured by, again, our proprietary monetary meter. The idea here is to track bond yields, interest rate regime, liquidity, and money supply globally. The output of this gives us direction whether we should move towards short duration fixed income securities, long duration fixed income securities, or equities. Again, we use 10 different indicators within the monetary meter to arrive at this. The next one, the very important one, is the equity market cycle. So these are the three cycle components: economic cycle, monetary cycle, and market cycle. We break the market cycle down in terms of valuations, and we create valuation regimes to understand where we are currently in a very, very long-term market cycle. We could have zones like highly overvalued, overvalued, fairly valued, undervalued, or deeply undervalued. We use 5 to 7 different indicators to arrive at an output and a concise view on where we are in the market cycle. And this has an impact on asset allocation. Each of the meter gives its own output on asset allocation, but none of the output of individual meters are used in isolation. All of them give an output, and that output of all the 9 meters is integrated to arrive at our final asset allocation on a daily basis. We only rebalance if there is a change in our trigger or our model indicates a regime change. We do not rebalance on a monthly, weekly, quarterly basis, and therefore it is important to understand that we follow a trigger-based rebalance rather than a time-based rebalance, because bigger events or regime changes do not happen with a set calendar. And for those reasons, our models are trained to be agile enough to be able to calculate this on a daily basis. Now, because it is calculated on a daily basis and it is a trigger-based rebalance, do we rebalance regularly? The answer is no. There have been years that we've rebalanced once in a year. There has also been a 1.5 year period where we've had no rebalance. There have also been periods where in 1 year we've had 5 rebalances. So how we change the asset allocation dynamically purely depends on data, how the economy, monetary, market cycle is evolving, and is any of this indicating a change in the regime. Now coming to the shorter term meters that indicate changes. The first one we use is a multi-asset momentum meter. This helps us capture trends in asset classes. We use a dual momentum strategy to understand absolute performance and relative performance of asset classes on its own and with each other to arrive at where is the trend building up. The idea of momentum is not to base our asset allocation decision on it. It is used only as a confirmation tool, because an expert would know that momentum is a lagged indicator. It captures a trend only after it has played out. We do not use it as a leading indicator. We use it as a confirmation tool. The next one is a meter specifically designed for gold. We call it the gold meter. Gold meter captures momentum of gold and relative performance versus emerging market and developed market equities, commodities, and the net long positions held by investors globally. The output of gold is used very selectively. So in a 20-year period, you may assume that the gold meter gets activated only 25-30% of the times, which means either it tells us invest in other asset classes or it tells us invest in gold. When it tells us to invest in gold, those are the times when we really need to be alert and increase our allocation to gold. In any other time period, we can have a neutral allocation to gold. The next meter is the technometer. We use technical analysis in a quantitative fashion to model it to support our asset allocation decision. Within the entire gamut of technical analysis, we have built our focus only on 2 aspects, which are the most critical for identifying inflection points. The first one is reversals to capture the mean reversion theory. And second one is breakouts to capture trend theory. Ideally, in any cycle, one of these two inflection points give you the trend or the outlook on the cycle. A reversal is when the markets are continuously going up, then enter a phase of consolidation. Post the phase of consolidation, they either break out and go up or reverse and go down. Our idea is to capture one of these two regimes. The next meter we use is the centimeter. The centimeter captures the overall sentiment of the market. This is the first of a kind tool that we've built, and we quantify the equity market sentiment by using 25 daily leading indicators. The indicators that we use range from how IT is performing versus banks, how metals are performing versus FMCG, what is the advanced decline ratio on a weekly, daily, monthly basis, is there breadth in the market, or we see strong polarization within the Nifty 50 top stocks? Do we see a euphoria in the IPO market? Euphoria usually indicates fear, ensuing fear. So right now, what is euphoria can eventually convert into a huge correction. So we use 25 such scientifically designed indicators, all of which are custom, to identify what the sentiment is. The sentiment can be bullish or bearish, and on a daily basis, it tells us whether the bullishness is increasing or reducing, or the bearishness is increasing or reducing. Usually, sentiment is not absolutely correlated with the market price movement. We are a month, 30 days early in identifying what can happen going ahead. The next meter is the relative value meter. Relative value simply tries to tell us that is there value left in small and mid caps relative to large caps? Relatively, are they still attractive or not? We capture this daily to identify zones of reversal. Usually, mid caps and small caps valuation peaks out at a certain zone, and those are the zones we want to be aware of and position our portfolios defensively at those stages. The next one is our global RoRo meter. RoRo stands for risk on and risk off. Idea is to capture the risk appetite of the global financial markets. We use 26 different global markets. Within these markets, fixed income securities, equity securities, and a classification into emerging market and developed market, fixed income and equity. Within fixed income, short duration, long duration. Within equity, large, mid, small. Over and above this, also commodities like copper, lumber, cotton, metals, etc. And crude, of course. The idea to track this on a daily basis is to get one final answer. Is the global financial world in a risk-on mode, or is it in a risk-off mode? The idea, again, from an asset allocation perspective is very simple. Domestic issues have an impact in the short term, but when the issue becomes global, if it's a global issue, it has a contagion impact. Usually we have seen domestic issues having a 10-12% correction in markets, whereas a global contagion can go up to 30, 40, 50, 60% also. So the global RoRo helps us protect our investors' capital in scenarios of a global contagion. And that is the idea why the global RoRo becomes an extremely important tool in the overall scheme of things. So with these 9 meters, this is the core and heart of our asset allocation strategy. We've taken more than 3.5 years with a team of 17 specialists to build this. Now that we have launched our strategy with the necessary SEBI approvals, we would love that investors participate in this secular wealth creation story by allocating money across the different asset classes.
Sorry, Siddharth, if anyone has the questions on this, because the meter is what Siddharth said, is something that we and in fact, last 3 years before we launched it, we were actually testing it in live market on our prop desk. After proper testing, we have come out and we have tried to take care of. So if you look at those meter charts, even in every meter, we have various sub parameters. So none of the meters are working in isolation. They cannot work in isolation the way our quant strategy has been designed. And at the same time, we have always been ensuring or trying to take care that we would always work on that. So Mr. Rao wanted to know about the global RoRo again. Okay. So basically, Siddharth, you want to take this global RoRo? I'll take it.
I'll take the global.
Okay. Yeah,
what
sure.
about the global RoRo?
So he just wanted us to re-explain it. So probably see how. Okay.
Okay. So I will explain it in a slightly simpler language also. So when we track all the different markets, so say Hong Kong, Germany, US, Canada, UK, France, etc. So we classify markets in different buckets, which is an emerging market and which is a developed market. Developed market and large caps indicate risk off. Small and mid cap and emerging markets indicate risk off. Moving into metals. So basically, if you're seeing significant returns coming in copper, base metals, crude, these are indications of growth in the economy. Growth in the economy can again be interpreted as a risk on indicator. Similarly, movement out of large and mid caps or movement out of emerging equities or movement out of government securities or movement out of gold. These are indicated as a risk of sentiment. And that is why we have close to 50 different daily indicators within global RoRo, which we track to understand what is the trajectory of risk appetite of the financial market. Idea is not to be too focused कि India mein what's going on in India. We need to understand now that we have so much FII flows and the global financial market is highly correlated. We need to understand if there is a contagion risk. Contagion risk means if US and Germany correct, will India also correct? If France and UK correct, will India also correct? In some scenarios, European markets operate or correct in a domestic issue. That is not as risky. But when the issue spreads across the world, that is a very high risk. And that is what we need to protect you for. I hope it simplifies it a little bit more for you. I think the bulk of the strategy has been explained. Now that the process is clear, we can look at returns and how we've performed across the different market cycles. So Nupur bhai, you want to take this one?
Sure. Thanks, Siddharth. So probably see the curves of any investments or processes is more to do with how or what return that asset classes. And I think so one of the questions that Manoj had asked earlier is about that how different asset classes have. So if you see this table, Manoj, you'll see the CAGR return of all asset classes, including not only India, but overseas NASDAQ, then the gold, and at the same time, how the long, obviously the bond funds or the gilt funds are always considered to be earlier. After a few, now there are problems there as well.
What is the date this table has been computed? Up to what date?
This was on the 12th August 21.
Okay, so when the market is almost at the peak. Now, two things, particularly from this chart. One is we talk about a strategy generates a CAGR of 21% and done on a proper back testing, which is done for about 15 years. Now, this is basically a fund of fund, right? You don't invest in stocks directly.
It's not basically fund. You can call it as fund of fund because my exposure is via ETFs. Okay, so that yes, the ETFs are represented by AMCs. So what you say in turn, yes.
And this shows actually because of your kind of a strategy, you will be outperforming most of the funds you are invested in by your selection of the ETFs.
Exactly. So
and also having a lower cost because of the ETF investment model, right? Which
So
Warren Buffett has been advocating for a long time.
So you are bang on target. The key essence of investing or selecting the ETFs was definitely the low cost. So making it as economical as possible. That was the key reasons. And see, it's all about which asset classes and when. So when we look at the charts of the various asset classes in the earlier heat map, which was showed by the, see, what is very important is we do never say that only look at the returns. Along with the returns, what is very, very important for any investor to look at is the two ratios, which are the pure denominator for the returns. One is your standard deviation and second is Sharpe ratio. Most of us are having a deep knowledge of markets. Everyone would understand. See, it's yellow bar represents my return, okay, my multi-asset return. But what is very important is the last two lines. The standard deviation, which itself will tell you that kind of risk reward that one needs to take. You look at probably the standard deviation of our fund is as high as 2.5 times vis-a-vis any. So Nasdaq, which we consider has been consistent performer for past many years, there also the standard deviation is only 0.94. So that's one of the most important aspects. And more than standard deviation, I always believe the Sharpe ratio that one should look at it. Probably our Sharpe ratio is lower than gold, which really, when we had designed this product, it gave us a lot of immense confidence that probably even the gold has a Sharpe ratio of 14.2, whereas we have a Sharpe ratio of only 11.9. So a product which has a good standard deviation with a Sharpe ratio combination, which helps you to protect your wealth in a market which is pretty volatile or decisive, and at the same time, because otherwise, if you look at my CAGR returns for last 7 years, it's probably okay. These are not net of expenses, but if you take it even at 20% on a conservative side on a 7-year, or probably upwards of 22 to 25% for the 5 years, which is very decent return only by allocating money to various asset classes. That's the key to this strategy. And at the same time, keeping your Sharpe ratio completely under control as an investor. That's what one. So you will never see a lot of whipsaws in our strategies, as you'll never see that my return in a in a particular year would go up by say 30%, in the next year it will be down by 20%. Those kind of volatility or whipsaws in our portfolio will never be witnessed, and that's what investors always look forward. Any question anyone has on this?
Yes, Siddharth, one particular thing in the strategies, the various meters you had, one of the particular one you mentioned about technical analysis also. Now, and that is often in the mutual fund industry, we talk about churning. Now, what is the churning you expect as per the strategy? That is question number one for you. And second thing is, based on the technical analysis, means do you use charts and the technical indicators, and you churn the investment in the various ETFs you have selected based on the charts, which are based on the NAVs of the respective ones, and you exit and re-enter to optimize your return?
Okay.
These are very critical questions which are often asked by investors.
Done. So I'll answer both of these. Firstly, in the last 16 years, we've had 45 rebalances. So ideally, you should be in the 3 rebalances a year on an average. Some years could be lower, some years could be higher, but roughly around 3 rebalances a year. That's on the churn ratio. Now, we do not use anything subjective or visual in this. The entire model, the architecture has been created in Python. We have our own software now built to do this for us. So we do not rely on any visual analysis. We use numbers and data to do technicals. So we capture reversals and breakouts not via pattern analysis, but via data analysis. So there is a technical analysis, visual science, and there's a technical analysis, quant-based science. We use the other one, which is purely driven by data. I hope that answers your question.
Yeah, a related one. People often talk about a fund manager risk in actively managed funds, and passive funds often they say outperform. Here, of course, this is a hybrid fund as per your strategy, and which also generates a very good CAGR based on your back testing over a long period. So what is, how do you say, is a fund manager risk? Is there a risk on you as a manager, or that risk is not there, or to what extent is there? Can you explain in detail? So before one puts his money, one is very clear on the strategy, whether it's a fund manager based strategy, or is it a clear total quantitative based strategy. One is very clear and one can sleep well based on the return, irrespective of the fund manager, whether it is Siddharth or whether it is anybody else.
So Manoj, in our case, let us be very clearly that none of us, so maybe me as a principal officer, Siddharth as a fund manager or an investment committee, would have any say. Our rebalances are purely based on our in-house proprietary meters that we have developed. And whenever we get the triggers in our meters or the rebalances in our meter, we ensure that, as you have rightly said, no human intervene at all. It will automatically get rebalanced. And this works 24/7. Our model works round the clock because we track a lot of global markets as well. So suppose, say, for example, if my meter tomorrow tells me that, for an example, reduce X percentage of exposures in a particular asset classes, then neither Siddharth nor Nupur would have a say that whether they would like to overrule. There is no concept of overruling. It is pure disciplined approach, and that disciplined approach is showing you in this yellow bar. If we leave it up to human, then this kind of returns will never be generated because humans always have a biases. And our rebalances are always happen on the trigger base. So when I say like, one second, there's one question. You have replied me for the question.
So Siddharth.
So when it happens to the rebalance, so we have one question that how do we rebalance? So it is very, very important for you, everyone, to understand that our rebalances are purely based on trigger and not on, I would say, so say, for example,
I'll give you the output. So every day a sheet is generated, which gives us asset allocation. So all the different asset classes and the weights for those asset classes versus the weights on the previous day. This output is generated. As if there is no rebalance, both the two will be the same. Yesterday ka allocation and today ka allocation is the same, which means there is no reallocation. If the values change, so say equities go from 10 to 25, or gold goes from 25 to 10, or something goes from 30 to 10. If the numbers change, means the model has suggested a rebalance. That is how it works. Ideally, now answering your question, Manojji. So it's taken us 3 years to build this strategy. I have been a critical part to build this strategy. Now that the strategy is built, as a fund manager, I have one critical role, making sure my model is running efficiently, my technology is running efficiently, and we keep reviewing, improving the model on an ongoing basis. So the decisions, while taken by the model, I do not intervene once the decision is out, but to review, manage, upgrade the model, I am important. So that is how your allocation will be managed by the model, but the creator of the model is also important. So it's both ways.
So Siddharth, one thing on this, you talk about a model and your role is as a creator for the model. Now, can this be fund be run by a artificial intelligence based model, or by itself? Because you have the parameters for the model. It is very, very clear. So can it be run as a program to ensure zero fault error?
It is running as a program only.
It is running as a program. So your role is, as a member of the investment committee, you constantly review, and that the strategy which has been assured by you in the offer document is implemented 100%, right?
Absolutely.
And you also confirm what Nipur said, there is zero fund manager risk.
Absolutely, there is no. So tomorrow, even if I am not there, the model will still run on its own only.
And yeah, so clear confirmation, there is zero fund manager risk.
Zero fund manager risk.
And Acha, can you also share who are the active people in the investment committee who are involved in active decision making, not just for the label, for the from that angle?
No, so there is no active people in the decision making. We have a team of quant specialists, economists, CAs, Python programmers. That is forming the team and that is worked on the strategy. And right now we do not make decisions on our own. Once the model gives us the output, we have to get it executed. That's it.
How often the investment committee meets? As per regulatory, investment committee has some accountability.
We meet every day.
Investment committee, I'm saying, the formally.
No, formally.
Not the fund management team.
Okay. Nupur?
You see, the investment committee, as per regulation, probably we generally, so when you say those minutes and all, it's always done only once a month because you don't need to daily. But our model, as I said, which we generally work upon, runs 24/7 live. So that, as Siddharth said, daily is that those meters readings are read on the daily basis. Now there's one question from Mr.
Yeah, in fact, Vinay, I would like you to put your video on and speak also to the presenters. We have seen your question. He has also seen. Vinay, can you put your video on and do a live interaction? That would be nice. I think it will be appreciated by all.
Yeah, hi, just a sec.
Yeah, I would just like to mention Vinay is a market veteran and very, very sharp questions he has been putting in the chat box, and also as a series would be a regular participant in the series, getting a lot of market veteran fund managers and mutual funds and PMS also. Yeah, now we have some live session, and with it, you are also there, Dushyant, Manish. Be ready. In fact, Mr. M. Narendra has also joined us. Mr. M. Narendra is on a board of a top 5 listed company and has been chairman of a well-known bank also. Yeah.
Yeah, thanks, Manoj. Nupur, Siddharth, excellent presentation and very nicely explained to us. So thanks for that. I just had a question about rebalancing. I heard that you said that every day the system will generate what should be a model allocation based on the previous day's parameters. And then if it's the actual investment, is different than what the model is suggesting, my question is that would you then do the rebalancing that day itself? I'm asking in the context that a lot of times, even if it's a quant-based model or a manual model, rebalancing is done only on particular, fixed times, for instance, once a month, etc., which I know that's not the way you all are doing because you said it is trigger-based. I just wanted to understand that rebalancing a little more.
Sure. So we've had a recent rebalance on not this Friday, last Friday. We got a change in allocations. We had 26% allocation to equities, which has now gone north of 45%. So what we do, on the day we get the allocation change, first we have to sell something. So say we have to sell our liquid funds or bonds or gold. So we sell it on that day. To get the money, we take 2 or 3 days after that. It's a T+2, T+3 settlement, right? Once we receive the money, that is when we redeploy it. So the rebalance happens on any possible day, but the rebalance process itself takes 2 to 3 to 4 days sometimes.
Fair enough. Good. Thanks. But I just wanted to understand, is there a minimum trigger differential? For instance, supposing, equity. Yeah. Okay. You got the question.
I got the question. So at an overall level, if the rebalance in 3 or more asset classes is less than 10% of its current weight, we do not do a rebalance only.
Fair enough.
Because 42 से 40 करने में I have no benefit, to be honest.
Yes.
Yeah, 37 से 39 exposure बढ़ा दिया, we don't do that.
Right.
It's a proper significant rebalance, only then we make it.
Good. Thanks. And the another question is, what are the tax implications for you all as a PMS as you do the rebalance. So whenever you are selling something, there will be a capital gain,
Yes.
etc. Yeah, unlike a mutual fund, right?
Capital gain
Yeah.
tax that are applicable.
So
As-
what happens that as a PMS provider, we'll have to provide LTCG statement to all the investors, right? So our software would take care for the equity related ETFs, the equity taxation of LTCG and for our non-equity, that's debt side, would have those implications or the laws applicable to the debt side. So we will provide a detailed LTCG statement to all investors, and they will be able to change or work with their chartered accountant based on the LTCG statement provided by us.
Right. So your CAGR, which you have written here as 21%, would be all pre-tax.
Yeah, it's purely pre-tax. You're absolutely
right. Okay, thanks.
Okay, Mr.
What
Rao.
is the post-tax number
That
you
will
expect?
work out, because usme kya hota hai, Manoj, that in a year we are doing that. We have just putting in some tables because see that the biggest problem there will be that how much time I'm going to be in a debt or an equity. If I'm equity heavy, then we all know that it's if it's a short-term rebalances, and then it's 10 and 15%. So that ratio of debt to equity we are just trying to evaluate, and we'll be able to give you that number once we are through of deployment for some few quarters.
And you get the benefit of set-offs also in tax. So
That's up to you. So see, as a PMS provider, my job is only to provide CA certified LTCG statement, and then the rest is up to investors at how they take it in their personal book. We have one question from Mr. Rao. 1 second. A significant reallocation pre-asset class for the differential in trigger. That is, I mean, 10% Siddharth. Okay. So, Mr. Rao, if you could just specifically ask me what's the question, because reading it, I'm not able to understand that significant per asset class. That's what is it that you want?
Yeah, can you put your video on, introduce yourself and speak? That will help the...
Yeah, sorry, I'm traveling. I'm in the car, so I can't put
Sure.
the video. It's unsteady, but I'm Ramnath.
Introduce yourself in one line.
Yeah,
so
I'm a
people
chartered
understand the
accountant, and I have my own wealth management business. I don't do the regular CA practice. So I find this very interesting. My question was to Chintan, who said that, only if there is as Mr. Vinay Somani had asked, what is the differential trigger that you are used to do the rebalancing? And Mr. Siddharth had said that only if it is 10% or more, then we do it, right? It is not like if there's a 2% difference, we don't, he said we don't. So my question is that 10% by each asset class, or total when you see it across various asset class, overall it's coming to 10%, then you'll do it?
In 3 asset classes, there has to be a 10% change, which means if I have equities of 20%, then there has to be a 10% change for me to consider that over and above gold and fixed income. So across 3 asset classes, still there is no 10% change. We do not make the rebalance.
Okay. So gold has to move from say 20 to 30. Equities has to move from 20 to 30. Your gold can still be like, say 2%, right?
Yeah.
And your fixed income has to be like 9% or something. That's when you actually do the rebalance.
Yes. So out of 7 to 8 asset classes, at least 3 should and will get, because when there is a significant regime change, if we'll never get a reallocation for 4 or 5%, we will get 20 ka 40, 80 ka 50, 50 ka 75. We get big numbers that time.
Got it. Thank you.
Good. I would like to acknowledge, Mr. Rao is a very enthusiastic wealth advisor and tracks lots of fact sheets deeply.
Great.
We have Vidit, Dushyant also, Manish, some thoughts from you?
Presentation is very, very nice actually. And whatever they say, I fully agree. Can you hear me?
Yes,
Yeah, we
yes.
can. Manish. Thanks a lot for your acknowledgement. Thank you.
And
Manish,
really,
what do
very
you think about the
descriptive.
returns? 21% returns, isn't it mouth-watering? We would like to have some critical analysis from you.
So PMS, I tell you very precisely, I have never paid an attention to PMS in so many years. Reason being, very precisely, I don't have that much money to invest in PMS. So I never paid any attention to that. But the things are really good. Somebody have a lot of money and don't want to do anything on his own. PMS is the best option.
Nupur, what is the minimum amount and
50
maximum?
lakhs as SEBI regulation.
Yeah, what is it currently? Minimum and maximum? And average expected?
So 50 lakhs is the minimum threshold from Jan 2020 onwards. And post that, any top-ups over and above 50 lakhs are most welcome. Then the top-ups could be, so generally see what we also do, and as Manish rightly said, even if we have an investor, I always tell them that just remember one thing, that even if suppose somebody comes to me that Nupur, I would like to deploy 2 crore or 3 crore at a shot, we always tell them that do it in an, say, start with 75 or 80 lakhs right now, and let's have an SIP book of 5 lakhs or 7 lakhs or 10 lakhs. And that's what we have been doing it time and again. So you can have, we have an auto debit SIP for process also, whereby after initial investment, client can always go for an auto debit SIP from his or another account, because it helps us also capturing the different market cycle, and it definitely adds up. Our personal study says that after lump sum investment, if you are doing a regular SIP in the PMS, it actually adds to your value, because you get a lot of advantages of the various market cycles.
So you are using that mutual fund strategy, SIP, PMS sahi hai, is it?
Yeah, exactly.
So when are you going to start a campaign PMS sahi hai?
Probably soon, when all PMS manufacturers comes on the same board like a mutual fund.
When do you think it will happen? Is there a PMS self-regulatory organization?
See, unlike a mutual fund, now from Jan 2020 onwards, we have seen SEBI actually taking active participation and doing lot of changes on the regulation side. We have some large aggregators nationally who are putting up the returns of the various manufactured portfolio managers on table. So these things would definitely happen, but it takes some time, because ultimately every manufacturer had a unique things to offer, and there were a lot of I would say disconnect. There was no common platform. Now, because the size and ticket size of an investor increasing to 50 lakhs, which is becoming an HNI product, now we are seeing even regulators are also actively, there are code of conducts for distributor, which was never there in PMS. Upfronts are completely stopped. There are no upfront, nothing. So those are all advantages which has come.
It's very interesting to see you are talking as a manufacturer. I hope you are looking forward to take advantage of the PLI incentive scheme of the government rather than being a service provider. Acha, Nupur, one specific question from you, yes, which some participants have shared. Suppose somebody is putting in 50 lakhs. That is a limit minimum. You know, earlier it was 25. And suppose there is an emergency, there is a need for 5 lakhs. So what does a person do? Can he withdraw 5 lakhs, or he has to give the all 50 lakhs back, get his all 50 lakhs back with the changes in NAV and re-enter later when he can come in again with 50 lakhs?
So, Manoj, see, in PMS, any top-ups or withdrawal needs to meet the minimum threshold account. So if my 50 lakh goes to 60, 65, then I'm allowed to withdraw over and above 50 lakhs. But at the time of withdrawal or at the time of top-up, my earlier day NAV has to be 50 lakhs and above. So, if I'm a long-term player and if I make money, suppose if I had invested in 2018 and today if my value is from 50 lakhs has gone up to 68 lakhs, I'm allowed to withdraw my 18 lakhs or even part of my 18 lakhs. but I cannot go below 50 at a time of withdrawal, or even at the time of top up. I cannot top up less than, so suppose, say for example, if somebody had put in money during IL&FS crisis in 2018, say Jan 2018, when markets were very good, and all of May, June, we saw that IL&FS crisis happened, and the shadow bank collapsing and a lot of other things. That time, suppose the NAV of 50 lakhs or his valuation of PMS of 50 lakhs goes down to 40 lakhs, and he'll come up and tell that I want to put only 2 lakhs or 5 lakhs. Not possible. He'll have to at least top up to 10 lakhs additional to make it 50.
The question was emergency need of 5 lakhs. Person has invested 50 lakhs and there is an emergency need. So does he break all 50 lakhs?
Yeah, profit can be withdrawn, keeping 50 lakhs as a threshold.
So suppose he needs 5 lakhs, that means he has to withdraw all 50 lakhs and bring the money back whenever he has.
No, not like that. Suppose if the valuation of PMS from.
One second, we're not talking about valuation. The specific question is somebody puts in 50 lakhs and there is an emergency need of 5 lakh rupees later, which was not foreseen. So he wants his 5 lakhs. He has no choice. This is the best money. These are his savings. So does he need to withdraw everything? And
no, that's what I'm trying to tell you. That suppose if you have put in 50 lakhs and
he needs 5 lakhs, so does he withdraw all 50 or he'll get 5 lakhs? From your answer, he won't get 5 lakhs. That means suppose he has no alternate liquidity available, so he has to exit fully and re-enter, correct?
No, not like that, Manoj. Suppose if he had given 50 lakhs to me, and suppose valuation of his 50 lakhs, market valuation of his holding goes.
It's 50. Suppose it is 50.
If it is only 50, then no, then he cannot withdraw 5. He has to withdraw fully.
So if he needs 5 lakhs, that means he has to withdraw all 50, correct?
Exactly. If valuation is 55 and above, then he can withdraw 5 lakhs.
Okay. Now, is there a lock-in period or there is an open-ended fund?
In PMS, you cannot have setup fees. You cannot have lock-ins. PMS are agnostic, so you cannot have any setup fee and you cannot have any lock-ins.
It's a no lock-in, so one can get, it's a liquid fund. We can get money anytime, right?
Exactly. And in our strategy, we have also have one additional point that we have not kept any exit load also, which most of the PMSs keep exit load. We have made exit load 0. So what you say, absolutely right. If you give me money on 1st of August and you call me up on 10th of August saying that Nupur, I have some medical emergency and I need my funds back, then we will liquidate everything and credit your bank account in 4 to 5 working days. So
excellent. Siddharth, something for you, a related one. In fact, Nupur has answered it partly. Now, a lot of people have liquidity. No, savings are there. And can this fund, Siddharth, you are there?
Yeah, I'm here. I'm right here.
Can one use this fund to park a temporary liquidity? One doesn't know 1 month, 3 months, 6 months after maybe this. Now there is a lot of people are taking conservative views. Of course, many are making money by direct investing in the market, but for whatever reasons, can this fund or should this fund be used for parking temporary liquidity where the period is not certain? It could be 1 month, it could be 3 months, it could be 6 months.
Okay, I'll answer your question. So in any 1 year rolling period, we have the worst we have done is 1% return. But between a 12-month rolling period, we could have some drawdown, which means because of fluctuations in all the asset prices, you could have seen a 3 or 4% reduction in your asset value. If you're okay with that, then why not? If not, then park your money in liquid funds where at least your money is at its net asset value. If you've invested 100, you're sure you'll get 100 back.
So somebody wants to, let us say, invest for 3 months. Now, considering the market view, and we also know a lot of liquidity is being pumped in by various governments for looking at the second wave, third wave. Money is available. Even the RBI monetary policy is very accommodative. So in that case, should one park money in a bank which is giving you 4 to 5% pre-tax, or liquid funds also? What is the return you are getting in liquid funds?
4 to 5%.
Yeah. or this is a better strategy considering the short-term outlook you have been coming out on a regular basis?
Right. So,
or is it yes or no, a clear answer, because there are lots of investors
no.
who have
Answer is no.
ample liquidity and they are put in their savings, but they don't know what to do next.
So answer is no for a 1 month, 2 month, 3 month perspective, because this product is for serious long-term investing and wealth creation. We do not encourage, people parking their money for 1 month with us, because that A, disturbs how we are able to manage the money, and B, also doesn't guarantee investor in 1 month. We cannot say that we'll get this allocation right. But over a long period, 80% of our allocations have gone right. And that is the story that I'm telling you. In one, how I can manage your money and give you, rather you go for liquid or bonds only. That is better.
See, Manoj, what happens, how you need to look at it is, this strategy aims at asset allocation, okay, and cycles. Cycles are never short-term in nature, never ever short-term in nature. So if you want to make the serious money out of this strategy, then you need to ride the correct wave of the cycle with the maximum participation of a particular asset class, which is going to do far better in that cycle. If that is what you can successfully play, and that's how our strategy has been designed also at back end, that's the time you will get that alpha. So in a short term, I would always suggest, and I'll go with the view of Siddharth, that the best is to have liquid. But if you have a time frame of 3+ years, and when you know that you don't want to take your own risk, you don't want to get into whether equity is good or a bond is good or gold is good, or if you're even too worried that at 60,000 Nifty, should I park it, then best way to do is this only.
Acha, I'm Dushyant Shah.
Yes,
one question I have, just continuation of what the discussion was going on. Suppose the 50 lakhs is the investment amount, it falls to say 45 or maybe 40 for some reason, then the top up is a compulsory thing, or it's a
no.
So somebody has invested say 50 and it goes to 45, then he doesn't have to put that top up. So 45 may again come back to 50 or maybe 50 plus. So that allows
yes, market fluctuations, client don't have to participate at all.
Oh, great.
Now, change in the valuation because of market fluctuation is nothing to do with investor.
Right. Now my question is, how does your return compare with other PMSs? Because we keep on reading about the returns generated by various PMS schemes. There range from say 10% a month to maybe sometimes 15-20% a month and things like that. So how your PMS compares with the other PMSs?
Okay, so first, Dushyantji, what is very important is that currently in industry on a quant multi-asset side, there are no PMSs. I also run long only equity PMSs since 2010, where we are among the top performing PMSs. That's a separate story. But if you look at my current, what we could do or how we have analyzed ourselves is against the various funds available within the industry in a mutual fund segment. So if this map, if you see, will tell us our return versus, and these are the calendar year return. Okay, so this is from Jan to December. So the first column is our multi-asset dynamic MADP returns vis-a-vis various mutual funds within the industry who have, I would say, asset classes which are very similar to this kind of. But on quant side, basically tactical quant based multi-asset PMSs, there are none in the industry as of now. But still, if you look at our 3 years CAGR, they are far, I would say, better or in line than any long. So equity PMSs will do good in a year like 2021 for sure. And I'll not be able to beat that long only equity returns in the year like 2021. But if you will see the cycle of 5 years, definitely I will do far better. And that's what our numbers also proves.
So I would say there are two ways to look at this. One is that you see the yearly performance and variation between each of these funds and MADP. These are constituent funds. So the Nifty fund represents Nifty's performance. The small cap fund represents small cap's performance. The S&P 500 does that for S&P 500. So idea is you see the worst years and the best years to understand the whole protection participation. That is one thing. Secondly, we can use a mathematical total for the purpose of simplicity. And the third is we look at comparison in CAGRs itself. On a 3-year basis, say we have given 32.8% return. Nifty has given 14% return. Midcap has given 16% return. Nasdaq has given 30% return. Gold has given 50%. So yes, we have been able to outperform our benchmarks in a very huge margin. Similarly, when you also see a 14-year period, which is an extremely long period, we are at 23%. Nifty is only at 10.7%. Midcap is higher at 12.4%. So idea is we compare the returns and how by being tactical in these asset classes, we are able to generate more returns than the asset class itself by the entry and exit decisions. That is the whole idea.
Right, Siddharth, I see this table, just go to the this one. See, 1 year return, you are saying your portfolio is given 43%, right?
Right.
Now,
Yes.
this 1 year is exactly which period, like you are saying?
12th August to 1 year back. So the returns are on 12th August. So 1 year, 3 years, 6 months or 3 months will be from, so you go 11th August 2020 to 12th August 21.
Right, because you know this last year March 20, the market has fallen so low that anybody who would have invested after March 20, he would have definitely got the returns, maybe 50, and some cases maybe 100% also. But that is really misguiding. Why? Because the market which had fallen had bounced back. So really, one has to look at maybe somewhere around November, December onwards, what returns have been generated. Because if somebody compares March or April or May or June, then returns are going to show quite high. If you look at the next chart, Siddharth, if you can see, put the here also your 2020 returns are 55%.
Right.
Yeah, I believe that this is because the market had fallen so much, and then somebody who was having that guts to invest, they would have invested and they have reaped the profit. But then essentially the market has come back.
Absolutely. So if you see the performance of Nifty for that period, it's 15.8%. Why? Because we take it at 12,100 or 150 in January till December, maybe it was 14,800 or 15,000. That still is a 15% return. Why do we have 55%? Is because we avoided the crash in COVID and still participated post that. So our strategy return is going to be much higher than a pure buy and hold passive Nifty investment.
So you mean to say your fund would have liquidated the equity part maybe in February itself?
We actually liquidated in the first 10 days of February, which was 1 month before COVID happened.
Okay. Oh, that sounds great.
My question
I would like to mention, in fact, Dushyant Shah has board level experience in a very major JV of Hindustan Petroleum, HPCL, and has well known for studies like benchmarking, Six Sigma, Balance Scorecard, veteran in the markets, and very well known for IPO reviews, SWOT analysis. Now, there was one question, especially in the context of what Nipur and Siddharth said and what Dushyant said. It has come from a couple of participants. One is on the chart, the earlier chart, which shows very good data analysis, multiple returns. Can you come back to the previous slide, Siddharth?
Sure.
Yeah, here we have the data as on 12th August. And very good analysis, talking about 3 years, 5 years, 7 years, 10 years, 12 years. What if you are put to prepare the same data as on 31st December? Because many benchmarking studies based on fact sheets and data of various funds are done on December. and some people do on March. That's a financial year for India, and December is internationally. How the data would change? Would the inferences would be the same? If it is possible, maybe you can do it later and share it. That's one point. And the second point is, how often do you come with fact sheets? Is it a daily basis, weekly basis, or monthly basis?
So we do one monthly communication, Manoj, with all our investors in detail about few key points. One, how the markets or the meters have gone for last 1 month. What is our current allocation or how our meters are saying? Along with, so I will share our latest July month with you, which you can share in a PDF, which you can share in the interest of all the members. And we also come out with what the latest meters or the global cycles are saying. So every month we write with our detailed note to all our investors, and we are in process. It is in very early stage, so I'm not committing anything as of now, but probably we will provide some kind of live portal also to all the investors where they'll be able to see the balances of all these meters in the interest of the investors, making it more transparent. See, PS always believed in being as transparent.
Real test strategy is now, luckily, the market is giving excellent returns. Hopefully, it will continue because of the India growth story and the strategy of the fund and the government strategy also. The point is, when the NAV goes down, maybe 50 lakhs becomes 60 lakhs, 65. When 65 becomes 60, what happened and how your fact sheet explains, and then you come with a review maybe after a month and explain to it, so it revives it gives impetus to the confidence of the investor. So if it has gone maybe from 65 to 60 or from 50 to 48, what explains at the end of the month? What does your fact sheet say on a monthly basis? That will give actually a great idea and answer most of the questions.
So in our monthly newsletter, we address everything from the overall outlook on economy, markets, our view on asset allocation, what our meters are saying, what is the rebalance, if any, that we've had, and why and how we've performed in that period. So it's a 3 to 4 page that we write every month, and it answers everything that you would need to know about the strategy, about the performance.
And are your PMS funds reviewed or going to be reviewed by international agencies like Lippers and all, who are very looked at by a lot of global investors? There are lots of reputed agencies who do regular reviews.
Our data partners and
they come out with rankings.
Can we come on our data partners, Siddharth? So we have used, okay. So these are our data partners, which itself speaks about, so from where we take our data feeds, our indices are managed by Crystal and not by us. So we are using Crystal based indices and not our own indices. At the same time, we have this global leaders who are our data partners.
No, I was referring, Nipur and Siddharth, not to the benchmarks, but to the ranking of the reviews or the fact sheet which take place on a monthly basis.
Manoj, we've just started a month back, so we need some time, right, to go back to the agencies and getting it. So we will definitely be doing it. We'll have large guys also to do.
We have already spoken to Ernst & Young, and in due course of time, when we think it's good enough for us to scale up to that level, we will mostly be getting one of the big four as our audit partners. I hope that answers your question.
So no, I was looking to PMS reviewer agencies, not the big fours.
Manoj.
Yeah, that will also.
Manoj.
Yeah, I would now request Mr. M. Narendra is with us. If you can share your thoughts.
Yeah. No. I must.
And before that, I would like to say a few words. Mr. M. Narendra is on a board of one of the topmost 5 companies, a tremendous wealth creator. And he has also being a chairman and MD of well-known PSU banks, and has taken Indian Banking Association IBA at the forefront of the India growth story several years ago.
ये मनोज जी ये सब आपका एक good wishes है. Anyhow, no, as a board member and all, we, as you rightly said, we work for all the investors and minority investors. That is okay, but we ourselves are not investees anywhere. But I must congratulate both Nupur as well as I think Siddharth for a wonderful what you call this presentation. As a layman and all of us, we may not have the necessity or to know all of them, but at the same time that it will be very useful for always who are the regular investors. Now my question is, why the SEBI enhanced the PMS? I think earlier it must have been at a lower level, maybe 25 lakhs. Now they were enhanced to 50 lakhs. So is it that they want to cover only the high net worth individual, or is the PMS is also a risky that quite a lot of them lost sort of money? That is the one issue. Why they enhanced it? Because for a common, other that, of course, mutual fund is there, but if they want to opt for PMS, you are eliminating all of them below 50 lakhs. Second, that there is any discretion or a non-discretionary or something, or what is that? Because I came slightly late. So the entire thing is given to you, and I am not telling Prabhudas Siladar, because I know quite a lot about all of them. I met them in my banking career. But somewhere, somebody rogue dealer comes and he spoils the whole thing, and entire PMS people get suffered, because we had cases in the past, long back. The PMS per se, particularly for NRIs as well as general public, was not at all successful. A lot of people lost in the IT, IT where they invested and all the things. And I had to, even as a treasury head, I had to write off all the principal completely, and bank, all the investment went without anything, and we have to write off all that. So, of course, those are the very olden days of investment. Today, we have passed through quite a lot, and but this is all one type of bearish, or what you call boom period is going on. It may continue for some time, but we are not operating only India. We are also to operate from the global perspective. And nobody would have thought the COVID will come and it will remain even now, and it is not still going. And you are lucky that without any, that some people complaint is without any fundamentals also, the real economy being suffering, your market is booming and everybody is taking advantage, and somebody is suffering also. That is there. I have seen quite a lot of the other day, last time, derivatives were there. So many people suffered also. So Nupurji, common man like us, suppose we want to invest, one is mutual fund. Other than that, I want to take your advice, Nupur or Siddharth, through the PMS route, how you could help us in that. And some of the, when you are talking about good things, you would also say, these are the, we don't give any assurance on various risks. These risks are part and parcel of the market. This has to be borne by the PMS subscriber. Am I right?
Definitely. So I'll take both your questions, sir, and I'll also explain you the other. See, first, why ticket size was increased from 25 lakhs. So when PMS started earlier, prior to 2012, it was 5 lakhs. In 2012, it was increased from, I believe it was February 2012, it was increased from 5 lakhs to 25 lakhs. After that, SEBI never reviewed or increased any ticket size. So when it happened in 20th January 2020 was a precise date where SEBI came out with a circular saying that henceforth the PMS ticket size will increase to 50 lakhs. Prior to that, we had lot of discussion with the SEBI. We had met SEBI representatives. There was committee was formed. A discussion, there were a lot of other, and that was not only related to the ticket size, but lot of other regulation, and which I'll just take it in a half a minute or so. The reason that SEBI said that you add up a normal rate of inflation from 2012 to 2020, which itself will make it 25 lakhs to 50 lakhs. So they said that earlier when we had reviewed, it was 25 lakhs. Now we are again reviewing it to increase. You just add your rate of inflation of it will be much above 50 lakhs. We are still keeping it at 50 lakhs. And obviously, it also adds up to the maturity of investors. So PMS, they wanted more of a matured investors to come. And that was the reason that 50 lakhs, they decided that anybody who can write a single check of 50 lakhs or who can give an equity worth of 50 lakhs because in PMS, you can participate in various ways. One, you can give a check to the portfolio manager. Second, you can hand over your existing equity investments to the portfolio manager and they'll align it with their portfolios. And third, you can give the combination of check, equity investments as well as a mutual fund investments, and that can be realigned and 50 lakhs ticket size can be met. So that was a key reason of SEBI saying that with the nominal rate of inflation also 25 would have become much way above 50. So it's justified ticket size and we had to welcome that. Your second question about the discretionary and non-discretionary. So there are currently two offerings, or I would rather say the three kind of offerings that a portfolio manager can do, keeping a ticket size of minimum 50 lakhs as an investment. First is discretionary PMS, which we manage. So all our strategy in Prabhudas Lilladhar are currently discretionary in nature, where the decision of investing in particular asset classes or stocks in a direct equity PMSs or various asset classes in a multi-asset PMSs lies with a portfolio manager or a investment committee, or I would say another portfolio manager other way. And the third thing comes is second, non-discretionary PMS. We have not started, but we are just on verge of starting non-discretionary PMS. I am just working on that paperwork, and probably non-discretionary PMS also will come on board soon. And third is advisory under PMS. So we can have an advisory book also as a portfolio manager. Under advisory, I am just an advisor to my investor. Ultimate decision whether he would like to invest or not invest in particular stocks or an asset class will definitely remain with the investor. Now coming to the safety aspect, which is very, very important when the ticket size is increased to 50 lakhs. First thing, that in the recent regulation, the custodian has been made mandatory for all portfolio managers. So earlier custodian was mandatory only if your size of your portfolio management is above a threshold of 500 crore. If you are below 500 crore, you can have your own EP or you can use the services of some other depositories, and there was no need of custodian. Now, from January onwards, the custodian has been made mandatory for all portfolio managers. That itself gives the utmost safety to the investor that their securities, because ultimately whenever we invest in any particular securities, the stocks comes to the demat account of individual investors on whose name the account is opened in portfolio management services. So we are just the fiduciaries of the wealth and not the owner of the wealth. Ultimate beneficial owner is the person who's investing in the portfolio manager. Only decisions are taken by portfolio manager, and there are custodians under whose supervision those securities are held for each and every individual investors in their individual demat account. So any dividend declared by company also goes to the direct bank account linked to the dividend. So that is 100% transparency and the safety as far as PMSs are concerned. Most of the large PMSs like us or veteran would always have, so we have our internal audit every quarter for all our investors. We provide live portal to investors where they can see the transactions and all the details. So there are a lot of fair practices which will provide a complete confidence to investors that first, stocks are held in his or her personal demat account. Second, there are custodians to take care of it. So as a portfolio manager, I have no right, but there are the custodians who have a right over the assets. And third most important thing is that you get complete transparency of all investments, because ultimately you are provided with the login and the demat account is in your own name itself. A few advantages, sir, which I believe I have answered all your questions. Still, if you have any concerns or the doubt, please ask me.
Nupur ji, बहुत बढ़िया है आपने, because everybody must know what are the positive and other, and of course, as you rightly said, the best practices and best internal control or best auditing and all that. And you also mentioned you may also take top 4 or 5, whatever, for the what you call, and also having CRISIL and other agency giving you all the data, all that, that is also good. Only thing is, in the market, see, not with your reference, please, that earlier, that Carvey made a very big mistake.
Yes.
Name is a big name, but unfortunately they made a big mistake, and with all the control, how that happened, that is the one issue. And I think recently another small player, I think, Arcadia Stockbroking, that also failed. So how are these failures in spite of the SEBI and stock exchange, all that? How these failures are coming? Yeah, Nupurji?
Yeah. So see,
if it is any inconvenient, don't answer, but just generally
No.
heard that.
Sir, in every market, you will have a different kind of players. Since you are a very senior banker, you will also understand that within the bank also you have a banks. So in what happens, sir, that as a regulator, SEBI will always ensure, and they have always worked for the interest of an end investor, and we always appreciate. And whenever any decisions are taken by regulators, we have always believed that it has helped us to grow the market. Look at the market cycle which was there with PAN card coming compulsory to equity market. Time and again, we are seeing a lot of the market because confidence to the large institutions to put money in the market when it is very well regulated. So we can have those kind of uncertainties from one or two players because you have all kind of players in all kind of markets. But the broader aspect, I want to place it today, Prabhudas Leeladhar sir, we are in business for now more than 75 years. We started way back 1944. And you will really understand that if you want to remain long-term in any business, you need to be ethical to your investors. That's the only key to success. If you want to remain a long-term in a business, you need to be ethical to your investors. If you're ethical to investors, you'll remain. But however, checks and balances, there are ways, there are people, their motives are known to an individual, but I'm sure that no large or the good player will ever do anything which is their investors. That way the business will never sustain, sir.
Very good. Thank you, Nupurji. That is very only my one question that आपने बताया कुछ advisory भी वो हो सकता है तो वो भी SEBI guidelines के अंदर है और उसमें हमारा suppose हमने आपको advisor ऐसा लग के आपने हमको advice देते रहेंगे और हमने थोड़ा yes or no बोलते रहेंगे तो उसमें क्या charges आता है?
I'll come back to you, sir, if you provide me your
वो मेरा नंबर है ना मेरा नंबर मनोज से है आप लेके
I'll do it offline.
Offline करेंगे so that
Nupur,
what I mean that may be the one for some of them by the time you will also learn because by you are getting involved otherwise where it is fully discretion that there is no involvement by the investor. That's why
I'll take your contact details from Manoj sir and I'll get back to you. Don't worry.
Okay, thank you, all the best.
Yeah, Nupur, the charges part and all, you may also talk with Mr. Narendra, but then if you can just tell how it works like advisory.
Okay, so see what happens under advisory, sir, is that under advisory model, we as a portfolio manager are only advisor to your investments. Where to trade, whether you want to trade or you don't want to trade will be ultimately, so say for example, if I'm investing or I'm advising on your equity portfolio or a multi-asset portfolio or any other portfolio, then based on our understanding, research and our knowledge, we'll come back and we'll tell you that, sir, we have ABC securities currently in your demat account. We advise that we can move out of stock A to stock B and we'll give you a proper rationale that why are we advising, what are the reasons for us behind that advice. But ultimate call whether you would like to act or not will definitely be in your hand because there's there has to be an arm's length difference between an execution and advisory. So if I'm an advisor, I just advise you on your portfolios and your investments, and you will have to take decisions whether you would like to act on my advice or you would not like to act on my advice. So my advice will be backed on certain thesis, rationale.
Yeah, I understand. But what is the frequency of interaction kind?
It all, so sir, it depends at what kind of investments we are looking for from you. Whether you are looking for a very active participation, then there would be a dedicated advisor who will be allocated, and there can be a daily interaction also. If you are a passive investors who are a long-term in nature and will tell me that, no, you give me the ideas which I would look at least minimum 1.5 to 2 years. I don't like churning too much, or I'm not. So then the interaction interaction probably could be only once a quarter when the invested companies comes out with the results, and we can just review amongst ourselves that what we would believe numbers have been and how the numbers have actually come. So it all depends on your frequency and your I would say the way you want advisors to act for you. But generally wealth is created in long term only, sir. So we believe that whenever we, even in our equity PMS, when we take any decisions to invest in the company, we at least take minimum 7 to 9 quarter view, because the transformation of the stock prices takes a longer, unlike the kind of period which we are seeing currently where everything is too fast. But unlike, it takes time for stocks to get re-rated, and the larger money is made when you enter the stock, and when stock starts getting the re-rating, that's the time when you make the maximum money out of any investments.
Nipur, can you come to the previous slide, which was that growth model, which talks about Nasdaq 15 times, no, earlier one, Gilt 3%, there was a graph, yeah. Now here, actually, you have a lot of good slides. No need to rush through it, because every slide has conveys a different meaning. Here we are talking about Gilt funds. What's the period for this? 15 years, right?
15 years as written, yes.
Yeah, 3.2%, Nasdaq 15.7%.
This is not percent.
MADP is how much? Sorry, MADP is
this is not percentage. This is
25 times. Yeah, 25 times over 15 years, right? Yeah. Gilt is 3.2 times over 15 years. And now the difference, it talks about mid cap 7.5 times, large cap 5.5 times. This is mainly because of the statistical point of 12th August. If we do maybe December or March, the large cap may be more, or it may be similar to mid caps. But the main question is, Siddharth, you are the right person. MADP, you are talking about 25 times, right? 25.1. Is it mainly due to a quant-based model and churning? So you take advantage of the beta. That's why you are having a more than 5.5%. There's a big gap between 5% of large cap and 5 times and 25 times. The difference between large cap 15 years, 5.5 times, and MADP 25.1 time. That means your 50 lakhs becomes 12.5 crores plus, right?
1 crore becomes 25 crores. Let's keep it simple.
Right. One will become 25 and large cap 5.5 based on the back testing. Is this mainly due to your back tested quant strategy and churning the portfolio, taking advantage of beta and volatility?
So,
is the inference correct?
Yes. Let me explain this in 1 minute only. So the source of returns, there are multiple. Now, large cap doesn't have Nasdaq in it. Large cap doesn't have mid cap in it. So firstly, I get exposure to different asset classes that have different return profiles. Secondly, the tactical entry and exit does two things. A, lets me participate in selective time periods when returns are superior. And B, the biggest source of difference is avoiding the falls is the source of difference. In the last 15 years, if I have missed from a strategy perspective, if I have been able to avoid 5 crashes of 25%, imagine the mathematical compounding that causes. At 100 rupees, I have exited equities. At 75 or 50 rupees, I'm redeploying equities. That gives me double return. 100 to 50 ka loss nahi hua portfolio mein, that's one source of return. 50 pay, I deployed again. So I had double the money to deploy at that price. So that is my second source of return. Because of the exit and entry in and out of equities that we've done, we've been able to generate this return. Now, the other point is, when we move out of equities, it's not that the money is at 0% return. We are moving it to gold and other return generating instruments. So even at that time, we have some safety. And for these reasons, as you rightly said, a quant model is supporting a superior return rather than buy and hold strategy.
So quant model, dynamic model, and investing in ETFs, low cost and zero fund manager risk. Are those inferences correct?
Yes.
Now, what are the benchmarks nationally and internationally of such quant models? I think initially you said there is no other fund in India.
No, there are
similar
multi-asset
one.
mutual funds, but
Sorry?
there are multi-asset mutual funds, but we are first of a kind in all these scenarios. Quant-based multi-asset PMS that invests in passive securities.
So we are talking about benchmarks and their strategy returns. Multi-asset mutual funds, similar ones. Do we have one which gives back-tested strategy returns of 25 times over 15 years?
No,
Whether
no.
in India, what about abroad? Because most of the industry has evolved. PMS, there are over 6,000 funds to choose from. Do you have international benchmarks one can compare?
I'll tell you, Manoj, what has
similar
happened.
returns in a very well diversified portfolio, because your portfolio is very well diversified.
So what has happened, Manoj, that most of the mutual fund side, multi-asset funds, barring few of them, have very less year of history, or they've started. There are only few, 3 or 4 who started years back and who have a successful years of track record. So we will also, because this multi-asset investing into the various asset classes itself in India is in very nascent or early stage. So we'll have to go through the cycle, unlike our equity market, which has a years of history, and we have a lot of invested companies and other things. It will, so market itself will mature, it will take its own time. And definitely we do have mutual funds who are offering this. There are mutual funds, a lot of mutual funds have started also. There are a lot of funds who have also considering to coming for this multi class offerings and all, and it will definitely come in over the period with a lot of offerings. But in the interest of time, I would request probably that, because even Shilpa is waiting, all participants to know more about Shilpa also in the derivative side. If you
are, that's okay, don't worry about that, because then we have a series, because one can always come again. Point is on a critical issue. You said this is first of its kind. If it is successful, we have seen there'll be many followers, many funds will come.
Obviously.
But when you have come out with a fund, particularly Siddharth mentioned you had studied for 3 years, right? It is not by way of hype or suddenly everybody is talking about numbers and quant. You are not doing now. It is a very well considered strategy for last 3 years. So you would be having a lot of success stories internationally, which can help investors, savvy investors, putting in 50 lakhs to understand how they have worked in international markets. You mentioned there are 3 or 4 funds globally. So globally, how they are performed and what is the size?
One second.
And how they perform in a market when it fell, when there were multiple shocks, particularly last year. Some thoughts you can share on that.
Yeah, so I can talk about how our strategy has performed when the markets have corrected, not just last year, but also in years like 2011, 2008, 2014, 2015. I can talk about that. Globally, because the PMS data is so discrete, we do know that asset allocation is a huge category across hedge funds globally, but we don't have the returns data or compositions data for them. But from an AUM perspective, I can tell you that the top 10 quant funds that I've studied in the world manage AUM north of $80 billion on an average.
PMS funds?
No, hedge funds. Structure is naam alag hai, but you can assume they're doing a similar thing only. So if they are managing such large AUMs, we would assume they've done something right to attract this kind of capital. And we are just at the beginning of multiple themes right now in India. Quant is nascent in India, passive investing is nascent in India, and multi-asset investing is nascent in India. So from a growth perspective, we see a very, very huge potential in this entire domain. And the inherent nature of the product is we invest in indexed ETF. So the safety is so high that an investor should not worry. We're not buying Yes Bank and Vodafone Idea over here. so that the stock selection or the risk is so high that you lose your capital. We are buying index. Even if we go through a rough phase as an economy, the index will always bounce back. Maybe the composition will be different. Today we have Reliance, TCS, Unilever, Britannia, Nestle, HDFC Bank as the top 10 stocks, for example. 10 years later, these stocks will be different, but the index is here to stay. And that is the philosophy which should give you confidence. That's it.
Thanks, Siddharth. One more point. Your thoughts on the opportunities in the gift city. There is sudden opening up now, and everybody is talking about taking advantage of gift. Are there opportunities for such investments?
Sorry,
through
sir,
that
but I have no
platform?
idea on this. I have no idea on this.
Nipur, any thoughts?
No, Manoj. See, even gift cities, they are trying a lot of things. There are a lot of initiatives, but as we know, as Siddharth also said, it's very, very early. You will have to give that market to mature, and then the things would definitely come. So I believe that it will take few years, but definitely there are right efforts are made on the right side to develop the gift city, but it's too early.
What is the size of fund of this fund which you feel is optimum for management, Siddharth?
It could be anything. I mean, I can manage 10,000 crores also on this strategy.
No, I know that's your capacity because it's quant based, but optimum size realistic for 2021.
It doesn't matter now, Manoj, because you are investing in ETFs, which itself are representing the large liquidity. So that size constraint doesn't come because you are not buying a stock where you have to see the market cap and other things. You are buying only ETFs. So when you are buying ETFs, as Siddharth said, any money can be absorbed by ETFs.
So what size you are looking at in the initial phase?
With your support, I think so. I should in a first quarter, I should be above 500 crore.
Okay, that is fairly easy to manage, and of course that regulatory limit also of 500 to achieve in this year, and of course with the kind of return you have mentioned, 21 back tested. If you do over next 12 quarters, it should be much more. Of course, subject to the slide for your post-tax returns, which you are working out. So we will come out with a review when your fact sheet comes, and which will show the success and how one can improve upon the strategy and learnings about it. Shilpa, you are ready?
Yeah, so Nupur and Siddharth, a very good presentation and good insight into the quant philosophy.
Thank you.
Thanks a lot, sir. Thank you. We really appreciate, and I have already given my coordinates in chat box. Anyone wishes to get back to us or has any query or wants some additional data, please do write or call us, and we'll definitely provide. And we are also available for the further discussion if anybody would like to have.
Right.
And Siddharth, particularly, we would love you to interact when you see the slides of Shilpa. She has worked late night downloading the data and to come out with perspective on how we look at the market. And as you said, the inferences are based on data, not by hearsay.
Done. So before I sign off, I just want to take notice of this one slide, which is, I think we've not given justice to this. We need to see important years like 2007, 8, 9, also 2015, and obviously the recent 2018, 19, 20, how the strategy performs and how the other instruments perform. In 2007, when equities were doing extremely well, we could only participate up to 33.5%, whereas large cap alone was giving you 50 to 53% returns. But in 2008, when all those returns are wiped off, we still have 21% positive for the year, when large cap is giving you negative 52%, mid cap is giving you negative 60%, and small cap is giving you negative 70%. And come 2009, we are actually participating up to 75%. So at the end of 3 years, we have 75 plus 55, almost 140% returns versus large cap, which is at 74%, mid cap, which is at 100%, or small cap, which is at 113%. So idea is we are efficiently able to do the protection and participation over and above consistency. That is what is very important, the consistency aspect. Next, we would like to highlight the year 2015, which is our worst year. Worst year, why? Because on an absolute basis, we've generated 0.8% or 1% return. But in that year, gold is down 8%, large cap is down 4%. So in a year, when my constituent assets are not making me money, it is very hard for me to generate superior return. But the guarantee or assurance is that even in a bad period, we can protect your capital and we will not let your basic capital go for a toss. And that is what we've been able to demonstrate over the last 16 years of test period. The next thing is obviously years like 2019 and 20, where we've superiorly outperformed domestic equities and of course, gold and fixed income securities. Overall, if you see, we have been consistent in managing returns and in protecting downside in a huge way. So if you want to park huge money for a long time and safety of that capital is what matters to you, rather than finding a stock that can give you 4x, 5x returns, if safety is what matters to you, then a multi-asset approach to wealth creation must be considered. And I think that is what I would like you guys to take away from this. That's it from my end.
Siddharth, I am getting feedback. This is a most comprehensive review of PMS strategy fund over 2 hours and a rigorous study of the strategy, and also very well answered each and every question by market veterans and people who have experience at the board level and people who have got great experience in direct investing.
Thank you. Thank you so much. Do share those feedback with us also. Maybe you can share it with Nupur Bhai.
Certainly, I hope.
Encouraging for us, that's why.
Review, that's what we called. Of course, the market review is also ahead and the IPO reviews are also ahead. Share with all the participants. So you add much more zeros to the number. Nipur mentioned of 500 and you mentioned 10,000. It is possible, but the strategy has to work and it has to be proven by the fact sheets in a very dynamic way. And I hope, and I would just suggest, don't wait for your monthly fact sheets. It's a quant-based model. You should be the innovator and you should be among the first to share weekly fact sheets. I'm sure that will work. Take it and put it on your website. And also you have a very good groups your team is doing, which shares on a daily basis. The day you do on a daily basis, I wish your dream as a young professional to achieve over 10,000 crores would be achieved. Of course, I think in terms of dollar terms. That's why I refer to GIFT City. So more international investors request you to come out with more products based on quant strategies where they would look at dollar-based return and you would look at further allocation to see that your strategy is achieving dollar-based returns or maybe the multi-currency basket also. And risk adjusted. Risk management is the key of the game, which you have included in your strategy, right?
Absolutely.
So, Siddharth, now your views on what Shilpa has to share, that is very, very vital because there were a lot of dynamics last week. It really shook up the industry. It shook up the most or the topmost fund managers. Suddenly, what is happening?
Okay.
Mr. Manoj, you need to make me a host so that I can have the screen sharing. Okay, I'll just share. Just a second.
Nipur is our expert on the Zoom side. So those who are supposed to share screens and have got the screen sharing approved the slides can share it.
Shilpa, your co-host, you'll be able to share now.
Yes, but somehow, my document, it is showing it is unsupported. So just a second.
There should be a risk management strategy for that also. You can share it with Nipur also. He could also share the slides and you can interact. These are the options available, but you should be able to share. And I know you got wonderful slide based on very good data.
Yes, I have already sent to you, but somehow I'm not able to. I don't know, it's showing unsupported. Can anybody, so do you have the slides that I sent you yesterday? So can you just play it for me if possible?
Alternative is you can share the slide, send it to Nupur. He could share it right away.
Yes. So I'll do that. 2 minutes.
And Nupur, you already have a slides. Yesterday you had received it.
No, I don't have it on my Shilpa, just email it to me. I have my email box open. If you could just email Shilpa, I'll be able to share it.
Yes. Just a second, Nupur. I'm just doing that on. Nupur, I've just sent you. Did you receive?
Yeah, I have. 1 second.
Can you just please play it for me? I don't know, something has gone wrong.
1 second. If it's this problem with format, then it will be the same with me. Just 1 second. I'm just opening.
Okay, before Nupur starts playing, if I'll just start with the session, briefing up what we did last week. Last week we had an extensive indicators discussion about derivatives. What indicators do we follow on daily basis, on all regularly? In derivatives, few indicators like open interest, PCRs, rollover data, WIX, we all combine together to have a firm view on any script that we pick. So likewise, in the last week discussions, we had few sectors, few counters also we discussed, what are the support levels, how do we, interpret them. As I mentioned last week, instead of the fact that market Nifty was making new all-time highs, there were assumptions that is it on the heavier side, then how will the fall come, and how far can we see the downside. But like I mentioned that 16,200 to 16,150 is a very strong support. So breaking that doesn't look like, and maybe 16,500 is something we might touch. And we have done that also. On Friday, we touched 16,500. We made new all-time highs, and even with the fall that we are all talking about, we didn't break 16,150. The support was very strongly held on. Apart from that, hello, yeah, am I audible?
Yeah.
Okay. Last week also, like when I was making you guys understand how to pick up scripts while following indicators in derivatives, we picked up scripts like Piramal Enterprises, then we talked about Tata Consumers, we talked about Gale, we talked about few scripts, and in that 1 week only we saw Piramal from 2580 it tested roughly 2700 plus. So in just a week's time generating a profit of more than 7 to 10, roughly 7 to 10% in a script like Piramal. Then we saw Tata Consumer moving from 760 to 800 plus. There also we gained roughly 5% and above in 1 week. So that is how the script has all performed. If you understand the derivatives data, then you will know when it is a sell, when it is a buy. But of course, not from a very long-term investment view, but yes, trading perspectives or very short-term ideas. Derivatives gives you a very concrete. So this session, I would like to highlight, and make every how to read, how to read the weekly data, how to understand the same way that we did, looking at each indicator. But this week, this session, I would like to highlight, how to read the weekly data, so that, at least on Friday evening, when somebody is downloading the data or somebody wants to know how the coming week, or let's say a 15 days view is there, how are we supposed to judge that? So this is what is something I want to cover it in my, limited time of my session. So
Shilpa, there's some, I think so, format error, because for me also, I'm trying to open it.
yeah, actually this is, I don't know why, but till yesterday it was so right. You are also not able to open it, right?
Yeah, it's I'm not able to when I'm clicking it, I think so there's some it opens on my iPhone but not on laptop. I don't know why.
Okay, it's not opening on my phone, on my laptop also.
1 second, let me send you on your phone. Just give me 1 minute if I can do that. So I've sent an email to you. If you could just check. If you can just I've tried something from my phone. Oh, God, no.
It should work, Nipur. You have it. Otherwise, Manish, you can also try through screen sharing. The presentation is also with you now. Manish?
Yes, sir.
Yeah, you have the presentation. Just check if you can share it on your screen.
Okay. I just want to ask one question to Shilpa if she's available for 1 minute. Shilpa.
Yes, sir.
You see that in FNO, there is if a company gives dividend more than 5%.
Yes.
Then there is some effect on FNO prices. Like I give you an example of 1 month back, HPCL price was 310.
Yes.
And they got 25 or 28 rupees dividend. So
okay.
Spot price came to 278. Vis-a-vis FNO price also came to around 280.
Okay.
And
So
there is some kind of adjustment happens. What is that?
So what happens, dividend play doesn't actually reflect much in, FNO counters. It is basically with only, cash, equity market. So, but what happens, when the dividend play happens, the spot prices either increases a lot or decreases a lot. So in that regards, what happened, we name it, when FNO, we see this kind of discount or premiums happening, we always term it as, corporate action. So which is, mostly dividend play or something. So in that matter, what happens, either spot price or the FNO price, they both have to have a mean reversal also, somebody has to catch up to one another. So it doesn't mean that, either if the, spot price has increased more than the FNO is, mostly in most cases, the FNO price also catches up. But usually it's just an adjustment with the prices that happens, but it is not very relevant in terms of, FNO prices. Dividend play will not directly affect FNO price.
I would like to supplement on this, Shilpa,
yes,
with your
sir.
permission. Manish, you have raised a point of dividend impact on FNO. This is a very valid point. I've seen even some of the dealers in brokerages are not fully aware. There is a regulation which is there on NSE site, which clearly mentioned if the dividend yield is over 5%, then the adjustment is done in the FNO. In the when the ex-dividend date takes place. And here some examples are, which you already mentioned, HPCL had a yield of over 5%, BPCL had a yield of over 5%, and also quite often we have regular recurrences. If particularly the dividend is combined, some split it up into interim and final. This India Bulls housing finance also yield is quite high, and there was an adjustment in ITC also in the earlier dividend, not in this dividend this time. This time the yield was less than 5%, so there is often no adjustment. If the yield is 5%, that means you buy a FNO stock at 100 rupees, you get 7 rupees dividend, and the market price adjusted based on the dynamics up and down. So there is an adjustment, there is a credit given to you by the broker for that adjusted price difference. It is also notified by the stock exchange on the website. So you know this, you can claim it as a benefit, so it is not your loss. Otherwise, some people are wary of investing in FNO derivatives in terms of that dividend period based on annual performances in usually that May, June, July period.
Yeah.
So if the dividend is less than 5%, you have to worry. 3%, 4% is quite a lot. So you should be calculative about the strategy of buying and rolling over, because 4% is also quite high dividend in normal markets. Of course, now they are rising markets, so dividend yield for 3-4% is quite considered quite okay when the market is going at over 5-6% in a week or in a month. So these are specific issues of some specific companies where the yield is often more than 5%. The adjustment is there.
So
it is notified on the stock exchange site.
To just sum up that if I bought a HPCL future at 310, suppose, and after 3 days it has become X dividend, so do you say that I'll get a credit of 25 rupees into the lot, which is around 2,300, which comes to more than 50,000. So 50,000 rupees will be given to me in FNO.
You should get it. It is based on the dividend yield at that stage of working out that XD price. If it is 5% or over, you will get it. But if it is less than that, you may not get it. It depends on that, and the data is available on the NSE website, and your broker will also give it to you. It's a very clear, specific answers, and particularly in case of it has happened in many companies, it comes on that particular date itself when that adjustment takes place. Within 24 hours.
It will happen in BPCL after 10-15 days.
Which company?
BPCL mein hoga na, sir?
Certainly it will happen, because it is very clear. I think dividend is over 50 rupees, right?
Yes, sir, 58 rupees.
It will certainly happen. So when you buy BPCL today and the price goes down, you may not be a loser, you may be a gainer subject to market being okay, and it is subject to it fitting in the technical outlook. I request particularly Shilpa to look at the BPCL data, and if you can make out a view on your data. Could you get your presentation? Is it on screen?
Sir, actually the presentation is not working, but I have managed to take up the screenshot of what my main topic is today when I'm talking.
Wonderful. And Manish, you have it in your inbox. Can you try? You shared a presentation?
So that is okay. This is what is the main thing I was supposed to talk to. So I can start with this.
Yeah. It gives us sectoral clearly data.
Yes, sir. So like we have spoke about, last week about how open interest and volume and price action comes together. So I'll just brief it up again so that everybody has a clear idea. So whenever the open interest is in positive, it is high, price is also high, and volume is also high. So which means that the overall outlook for that particular sector or counter is bullish. Likewise, when open interest is high and price is negative, but volume is also high, it is a bearish outlook. And we talked about short covering stages and also the long unwinding stages. Short covering means when OI is negative, price is positive. It is a short covering stage, which means that either the script and the sector is going to see a brief upside, a very strong one and a very quick one, but then it might again move back into sideways zone. And long unwinding, likewise, when OI is negative, price is negative, and volume is also down, which means that either the stock has reached the climax stage, either it is going to go further down, or we might see a reversal, which in plain words, we term it as bottoming out. Either the stock has bottomed out, we'll see a V-shaped recovery, or otherwise it is going to fall further. So that is a climax. So we just have to wait for that particular counter. So if we look at this is the weekly outlook, what has happened in the past week for all the sectors across. So if we see, volume has been very high in the textile sector. It has been very high in the pharma sector. It has also been very high in capital goods. Technology has been doing good. Then we see media has been, seeing, very high in volume. But only volume will not suffice. We have to see how the OI built up and how the price action has been. So if we look at, then only indices, technology, power, just marginal, and chemicals, just marginal, have seen some kind of overall weekly positives. In all of this, indices and ITs technology has done very nicely. We've seen the rally, in HCL Tech, we've seen Tech Mahindra, we've seen Infosys, all the stocks, even the large caps, the mid caps, every counter, particularly in IT, has given very good returns. They have seen a very good rally. This is on the
tech sector is not in this slide. It starts from chemical, textile, cement, infra, pharma, auto, FMG, capital, banking.
So
are we missing out? Tech sector is not in this slide. Price, OI, and volume.
So technology, reality, power, media, it's not visible?
No, we could see banking and down. It starts with chemical on top and banking down -1%.
Oh, okay. So then I guess the screen is little higher. Let me just adjust. So now is it visible?
Yeah. 1 second. Yeah. Now it is coming. Yeah, banking, finance, index, telecom, oil and gas, metals, technology, realty, power, media. Yeah, yes. Technology, it clearly mentioned about increase in price.
Yes. So it is the overall sector has risen more than 3% with OI on the negative side and volume on the higher side. So which means that the sector is witnessing short covering overall, which also means not only on the weekly basis that it has risen, then for the coming week also, this sector looks very promising. We are very likely to see a very good upside going on for this sector. And in this, the favorite scripts in the large caps would be Infosys, as it has just crossed 1700 zones. So as long as it is holding for a brief period, also for a weekly target, if anybody has to look at Infosys, a stop loss of around 1700 or 1695 would suffice, and one can look for targets above 1800 and above. So a movement of further 5% to 7% can happen in Infosys for this week. Apart from that, Coforge is trading at around 4800 right now. So a stop loss of only 100 rupees, 4700. It is having a very good support technically also, and as well as for derivatives. One can look for targets of 5200 around. So risk reward is only 1:4 here. So you hardly have 1% of risk, and the reward is 4 times. So such are the counters where one can focus in IT. I will also show you the heat map, that we follow on weekly basis, wherein all the scripts would be there, how they have moved and what are they indicating. I'll also share that image with you right now. So this is, if you see technology sector is a promising one. Indices, we see that OI built up is very high, above 10%. Price has also risen roughly 1.5%. Volume is also good. So which means that, indices is still looking bullish. And if we talk about Nifty view, Nifty on fresh basis has formed a very strong support at around 1600, 350 zones. So 350 is also very unlikely that coming week it might break. It is very unlikely. And the further extended target for Nifty is, if it is trading above 16,500, we will see targets of 16,800 going ahead. So Nifty looks very bullish. Bank Nifty particularly, if we talk about, it has been consolidating a lot in the past 2 series now. 2 expiries I've seen. Stiff resistance of 36,000. Closing also after 6,000 on weekly basis, which means that it is giving higher, it is making higher highs and higher lows, which is a very bullish sign also for any counter to follow. So Bank Nifty, for particularly, please do make a note of it. It is looking absolutely bullish for not only for a week ahead, but for a quarter now or a month now. Everybody has to focus on banking stocks because they are the ones that they are long due to perform now, and they are on the verge of outperforming Nifty. Bank Nifty, if it holds 36,000 and the view what I'm seeing is right, then we will see in very soon. I don't even see 15 days. You will see targets of 38,000 and above, because Bank Nifty, like we discussed last week also, it is due for new all-time highs. Nifty is continuously making all-time highs and Bank Nifty is due. And when the Bank Nifty rally happens, rally of 1,000, 2,000, 3,000 points is very easy. So in that case, all the banking stocks, they are supposed to perform. My favorite picks would be, out of this would be SBI. It is trading at 425 to 430 almost all the times, and it has a very strong support at 415 zones. The moment it touches 420, 418, it is bouncing back. So a support very nearby at 415, one should look for a buy for SBI. It is very likely that SBI will test 470, 480, 500 also if this rally happens, resumes in Bank Nifty. Likewise, Bank of Baroda, it has been like an elephant sitting. It is not moving, but it has also been on a very good support zones. Keep a stop loss of around 78 max and trading at 81 now. It can test 90, 95, 97. And FNO, I must tell you, the lot size is very huge in Bank of Baroda. It is 11,700. So you can imagine the kind of outside the upside jump one can take if invested in FNO, keeping a tight stop loss. You can also hedge the same. If somebody's buying at 81, you can go for 80 puts, so just to hedge in case the downside happens, then your loss would be covered, like we discussed in strategies last week, where we minimize a loss when buying in futures and then buying fewer puts as well. So apart from that, if you are also Kotak Bank, it has been long due for targets of 2,000. It is currently trading at 1790 to 1800. So once 1800 it holds decisively, we will see targets of 2,000. So few banks, when the Bank Nifty rally happens, one must stay invested for such stocks. Apart from that, metals on weekly basis, if we see, it is showing price action as a negative, OI and volume pretty decent. We saw that metals throughout the week consolidated. We saw that fall also in the first week of the first few days of the week, where we saw brutal selling in mid caps particularly, but large caps were holding. That is why Nifty was also holding and not breaking any crucial supports. But on Friday, I'll also share with you the daily. This is the weekly sectorial update that I'm sharing. I'll also share that with daily now. You can see how the changes has happened. We saw yesterday, because of Tata Steel, how metals rally changed everything, and we saw new highs. Tata Steel making new highs. Just a second, I'll just share. Is it visible? Yeah, is it visible now?
Yes.
Yes, this is the daily update. If you see, metals was negative on weekly, but if you see, the only sector that saw huge volume is metals, and the price has been turned from negative to positive, almost flat one can say, But we all know how the things have happened because of Tata Steel, the kind of rally we saw. So coming week ahead, metals is again a turnaround story. You have to focus on metals, Tata Steel, JSW Steel, Jindal Steel. Many people are talking about Tata Steel having such, upside now. It has rallied so much. We have missed. If anybody's seeing that, you have missed the rally in Tata Steel, you can very well participate in Jindal Steel, JSW Steel. They have the huge upside play still running. But Tata Steel has given a fresh breakout. If one understands technicals or derivatives, above 1450, it has given a fresh breakout. So very short minus stop loss. It is trading at 1470 only. So very short stop loss of 1440 to 1450. You keep. Tata Steel should test 1600 zones coming week. And with that run, you will see JSW Steel testing 800. It is trading at 750 now. You will see Jindal Steel making the run up towards 500 as well. It is trading at 430 zones now. Nalco and NMDC, they are both at very crucial support zones, and we have seen the brutal fall for Nalco, particularly after the results. So it has come down from 96 to now 78, 80. Now it is again trading at 83. So it has tested its all supports and it has bounced back from there. So Nalco is again one very strong candidate in the metal sector if one has to focus. So, and also I would like to tell, in FNO, the lot size for Nalco is 17,000. So it is trading at 83 right now. So, you either buy at 83 or you try to buy at around 81 because the support is at 80. You have a very, very good upside to play now in Nalco. Tata Steel is a blind buy because of the commentary that we saw and, kind of discussions all we saw in Tata Steel being very bullish for the next quarter as well. So that is also a very blind buy. You should be invested in metals right now. Like we discussed, technologies, metals are clear, buys for coming week. Apart from that, banking is it should be on the radar, because banking will give the rally that everybody, for all the people who keep saying that we have missed the rally again, we have missed the rally. So Bank Nifty rally, nobody has missed. You need to participate in Bank Nifty. Then this is the bullish counters. So the people who want to short also, and they want to understand what are the weak counters. Pharma is one basket that one has to avoid right now, because pharma not only on weekly basis, on daily basis also is looking weak. And we have seen after the result season how Dr. Reddy or certain counters that have failed the estimates, and it has been falling down. Of course, it's a mixed bag also, because Sun Pharma has been doing very nice and Cipla is doing nice. It's a mixed bag, but we've seen the brutal fall for Lupin, then we saw Dr. Reddy. So pharma, one should avoid right now because it is looking weak, and going ahead, we might again see some profit booking happening. So pharma is a no category for trades. If anybody has to sell, one can look for this sector, particular scripts also. Like I said, Lupin is trading at 980. It can fall to 900 or 880 as well. 100 rupees fall is still there. So this is how the things would be. So these are the sectorial update that I've told you. Apart from that, I will also like to talk about, of course, I have covered the scripts factor as well. So any query on this part? I mean, from derivatives point of view, this is how we judge, the weekly outlook. If anybody has to ask me, from derivatives point of view, how do you see the week ahead? I see the week ahead still being bullish, because the FIS data, they have been pumping money still. Of course, not largely, but the FIs on futures and, they're buying options also. They're buying futures also, which also indicates that it is a bullish sign. So they are not showing any signs of weakness in the market. Apart from that, if we see the derivatives data, the technical data, Nifty is looking absolutely strong. The RSI is still at 70, 71. It has a scope to test 86 also. So we have again a margin up there where we can play. We talked about PCR. Overall PCR for Nifty is around 1.3 right now. The Nifty PCR, the history tells that even 1.3 1.86, 1.9 has been tested. So we also have a room for upside there also. So everything is in order for Nifty to still play the bullish card. And if Bank Nifty supports the counters right now, then we will see Nifty heading towards 17,000 also in coming, 15 days or so. But provided Bank Nifty also has to make that highs. But if to just sum it up, anybody who who wants to participate in this new rally, please be focused on few metal counters and banking counters. Okay, somebody is asking me which was the stock I suggested in IT. Sir,
Yeah,
I would suggest, Infosys. Please be invested in Infosys. Look for Coforge. Tech Mahindra above 1400 will again see a very fresh rally towards 1600 zones. You can look at Tech Mahindra as well. Of course, HCL Technologies is still lagging behind. It has made new highs, but still lagging behind in comparison to its peers. So it can test 1300 also. And Bank Nifty resistance and support. Bank Nifty, sir, as I've told you, a strong support at 35 to 35,500, but resistance also at 36,200 to 50. So once it sustains above 36,250, we will see the rally making new highs up to 38,000, 38,500 as well.
Shilpa, very good to come out with clear targets. You talked about the Bank Nifty and also Nifty, and you have gone right last week in spite of turbulence. You talk about banking, SBI and BOB. What about private sector banks?
So like I told
HDFC,
you,
RBL.
So RBL, sir, actually data wise isn't looking very strong. So RBL, for any good upside, it has to cross 200, so which is long way now. For now, it has support at around 155, so which is also way down. So RBL one should avoid right now. If wants to invest, you can, but also be prepared to average it out when it falls towards 150, 155 zones.
Great, wonderful. What about HDFC Bank?
HDFC Bank, as long as it is holding 1500, it is looking very bullish. In fact, HDFC Bank is the bank, it's a one counter only, the heavyweight, which is holding Bank Nifty and making it cross that resistance as well. So HDFC Bank is very bullish for sure. So I'm talking about, so when a new rally happens, so let's say my perspective is when Bank Nifty is supposed to make a new rally. So HDFC has been supporting it. So, but we also have to focus on counters which have beaten down, which have not participated. Let's say IDFC First Bank, because of Vodafone news, it has fallen down like anything. So, but it has a very strong supporter and 45. So, once it crosses 50, it will test 55, 60, 65 again. So, if that rally happens in Bank Nifty for 2,000 to 3,000 points from here, so we have a higher margin of profits in such counters where it has been beaten down. It has not yet participated much. So focus can be, mixed. So if one can play safe buying HDFC Bank, SBI Bank, but little higher margin of money one has to make. Then one has also to participate in Bandhan Bank, then IDFC First Bank. You have to create your, allocations as per that. So that you participate also in the safe trades, also taking a little risk where if the view sets right, you have a very, very high profit margin.
What about large and small NBFCs?
So NBFCs have been doing good. So you talk about, so let's talk about Bajaj Finance. So Bajaj Finance, trading at around 6150 now. So Bajaj Finance has a very, crucial range, and it has been trading in that range for the past 1 month or so, more than 1 month actually. So it is testing 6,000 as a support, and it is facing resistance at 6,500. So it is a very good buy if you buy around 6050, 6050 or 6100, and the targets of 6500, so that you have risk on the minimum side and you have a profit on the higher side. And sir, if you talk about
M&M Finance, India Bull Housing and HDFC.
So India Bull Housing, sir, it has a very strong support at around 225 to 230. It is trading at 250 something right now. So it can again test 300. So provided this rally happens, and sir, actually, and since iBull Housing Finance is in ban period right now in FNO, so price movement is also very stagnant right now. It is not showing much of a movement. But yes, it is a very volatile counter. Once it is gaining that momentum with the sectors performing, you will see upside till 300 again. So HDFC is a very favorite buy for everyone right now because HDFC has not been performing since a very long time. So, but it has a very strong support at 2500 right now, and you can stay invested for little positional targets of 3500 as well.
And Shilpa, this slide which you have shared very clearly sector-wise, and we have spoken stocks also, price over volume. This has been downloaded from the site, or you have prepared it based on the data uploaded on the site last night?
No. So when the data gets uploaded, so I have my so this is of course a downloaded thing. So but
downloaded thing.
So this you can very well get it from so any any software, so where you can see how the performance has been happening. So but then this, after the sectors, so the task comes when you start choosing your scripts. So let's say if I say, sir, chemicals is looking very strong. So but then chemical may what stock you have to pick. It is also very important. So you need to understand either I have to go with Tata Chemical or PI Industries or any UPL or whatever counter, what is looking good. So let's say I'm talking about IT. IT is looking very strong. So then we have a whole list of IT counters there. So a few stocks are in FNO. So there are many stocks which are not in FNO. So the point is that when a sector is looking good, you have and I'm talking about Infosys, I'm talking about Tech Mahindra, I'm talking about Coforge. So but then other than that, you must be having your own favorites. So then you also have to look at the peers also, not necessarily only the counter that I'm speaking about, the peers, of those sectors also, how they're performing. You can also stay invested in that.
Excellent thing. Actually, with just one slide, we could have such a wonderful discussion. I remember we had such a discussion with one slide on Bitcoin and cryptocurrency.
Okay.
And Siddharth, you are there? Siddharth? Nupur? Nupur, you are there?
No, sir, I don't see them.
No, that's okay. I was actually wondering, they should have a look at your strategy, and why not a derivative fund, which is based on such strategies, is a part of the quant, because derivative funds also give much better returns than the gilt fund.
Sir, actually, I have. So, if you don't mind, so can I share, the screenshot of what, performance of my desk gives. So if you want, I can share that also.
You share what you have based on scientific data analysis.
So just a second, sir, I'll just share it with you. Just a second, sir. So this is the returns that my desk in Prabhudas Leeladhar that has given from the past Jan 2020. So the table shows monthly how many calls have been given, what have been the profitable calls, and what has been the loss calls. So we have successfully managed to maintain, strike rate of around 70%. And the investment, the net results that I'm showing is that, based on provided, on every call, one lot, one has, participated, but assuming one lot.
One lot for every recommendation.
Every recommendation.
So what about the margin required?
So that is what. So what happens?
For total.
It's not a
when you give the net result, what is the total? See, we always look at ROI.
Correct,
now you looked at the monthly return only in 1 month out of practically 19 months, right?
Yes, sir.
It's incorrect. It's a wonderful performance. What about the ROI? Would like you to share the ROI.
Yes, sir. So let's say one has, let's say 5 to 6 lakhs of margin. You have, so then in that
one
case,
lot. You mentioned one for every call. Suppose one has invested in one lot in every call. This is the number return, right?
I'm seeing you. So let's say you have a fund with you of 5 to 6 lakhs. So then you can participate. So on daily basis, I give 4 to 5 calls on daily basis, which is a mixed calls, few options, indices or direct futures. So if you have a fund of 5 to 6 lakhs with you every month, this is the kind of returns one can expect.
So what is the percentage return coming to on 5 lakhs? Or 5 to 6 lakhs range?
So of course, it has varied every month. So if you look at July, it has been splendid, more than 50%. So, but then average of more than 20 to 30% per month, I have been steady. And where I have gone wrong, so I also have a drawdown in my mind. Let's say if I'm talking about 5 lakhs investment per month, so I have a drawdown, I will not take a loss of more than 25% to 30%. So if you see in Feb 20, I went wrong in just 3 calls because that was a very that sad day for me. It was budget day and I went wrong completely on my views, and it was such a whipsaw movement in indices, so I had to hit my stop losses. So but that is what I wanted to tell you also. The point is showing of this last February 20 net result also is that when I hit a kind of 20-25%, so I also draw down and then I stop and I have to think what went wrong, what happened, so that you still have margin so that you can participate again and do you can cover up your losses. So but if you see only in that month where I went wrong, only with 3 calls I've stopped. Other than that, I have been generating a steady outflow inflow of more than 25% per month.
So you are given a very good option to the people who don't want to invest in quant fund right now. Lakh rupees. So it's a 5 lakh, 6 lakh rupees option. But this can be stocks as margin also, right? They need not have.
Yes, sir. Yes, sir.
6 lakh liquidity.
Yes, sir. You can.
So in that case, the percentage return would be much higher.
Much higher because you would be earning in cash as well. So most
and you are talking about the stomach of a 25 to 30% loss.
I'm talking about monthly. Yes, that's a maximum. So that is what I'm saying. I'm talking about maximum. So even I don't do that. So but that day, like I've told you, why I'm mentioning the budget day. So because it was the budget event, and the kind of market fall happened, so it was not in my control to even exit much before my stop loss hit. So it was a very sad day and a bad day. So but then the point of showing this to everybody is that I also know my drawdown. I also know my understanding. I know when to stop also. It's not that you just go out playing blindly. But
so stop loss is put in advance or it is considered later based on the market dynamics?
It has always been given. Let's say I give you a call, buy Infosys right now at 1718, stop loss of 1700, target of 1800. So but what happens if that position is carried overnight and some bad event happen, or when things are not in a control, you might open way gap down. So in that cases you can't do anything, so you have to take that loss and exit and look forward. So that is what had happened. So
okay.
but
so they are gap down stop losses.
Yes,
yes. So no need to do intraday trading. One can do position trading on futures and
Correct.
rollover
We can
and
do
maybe
that.
gap
So
down
we
risk is
can
a
do that.
calculated risk one can take.
So we can do that. So, but if I would tell you, so since it is derivatives, I don't like taking much of a risk. I don't like taking positional trades much because, so of course, but nowadays, even gap down, gap up has been controlled to quite an extent with, those pre-opening things happening. So, but that is fine. So, but, even if I'm telling you, so if I give to 3 to 4 calls a day, and sir, my expectations, since it is derivatives, 1 to 2% if you gain intraday, so that is where I stop also. I book my profits as well. So the point is, so profits in your bank account is much better than only in your books. This is what I believe. So that is how I practice. So that is why it has been such a steady returns.
So distribution of the MTM gain takes place when you talk about profit in the bank, right?
Correct, sir. Correct, sir.
By booking the profit.
Yes, sir. Yes, sir. You
one has
should
to
have
be,
your realized profits more, sir. You just don't have to say on books that itna high gaya, itna low gaya. So you have to also see the realized profits happening in your account. So demat account.
so wonderful. So keep on downloading the data and coming out with such excellent calls.
Okay, sure, sir, sure.
I think can we have now Manish has prepared wonderful review, a sort of IPO and some small cap, mid cap companies.
So first, what you like to see first? See, I
What's
have
IPO food for the mind, the RSP analysis and the SWOT.
see, I have done only IPO updation containing how much they have done well. So all the IPOs, what price they have opened, how much they were subscribed, and all these things. A small slide, one slide for each IPO for last around 15 days. So let's start doing that first.
Manish, sir, just one thing, sir. People have been asking my contact details. So can you share, or do I share, sir, here?
You can share on the chat.
Sure, sir.
And you can connect on LinkedIn and Facebook also.
Sure,
so
sir.
that is a platform suggested by many participants. It's on platform is on LinkedIn and Facebook. So you can connect with your photograph, your qualifications and your profile. That is the best way to connect on an ongoing basis.
Yes, sir.
LinkedIn and Facebook. Yeah.
Can you see my slide updation on IPO? Yes, can we see updation on IPO? Hello?
Yeah, very clearly.
Yeah. See what from last July 14-15 से लेके आज तक जितने भी IPO आए हैं ना, I have just gathered the information, how much they have subscribed, what price they have opened, how much they made high, and what is the current price. If the shares are not still listed, then at what is the gray market premium? So we can think what is happening over this 1 month period. I think the pace has gone down in a big way, starting with Zomato. Zomato IPO came at between 14th to 16th July. These are the figures where total it was oversubscribed by more than 38 times. Issue price was 76 and lot size was 195 shares. This was that highest price, high issue size was the highest in this last 2 months of around 9,300 crores. The shares got listed at 115. It made a high of 147, and yesterday price was around 135. So what people used to think that there will be a lot of selling will come. It has not happened, and we have seen that Mr. Ashwin Damodar had, he brought some kind of valuations where Zomato is only valued at only rupees 41 per share. But market में ऐसा कुछ दिखता नहीं है. And I believe they have given a quarterly results where they have made a loss of, again, like they have made more loss, and their loss for the quarter was 360 crores. Correct? So this is about Zomato. Any question on Zomato? Tattva, Chintan, Pharma, this IPO came in between 16th to 20th July, and it was oversubscribed by 180 times. This was a good IPO, good company according to me, and there is a way, like investors can invest for a long time as per my understanding. Issue price was 1083 and issue size was very low of 500 crore. It went high up to 2486. Current price is 2175. People got almost money double. This is a good company for long term. We have Rolex Rings, which came on 27th July to 30th July. This was also subscribed by 130 times. Issue price was 900. Issue size was 731 crore. It opened at 1250, made a high of 1264, and current price is 1155. इसमें भी ज़्यादा selling नहीं आया है. Probably retail portion was less. That is the reason behind not falling the prices. Glenmark Life Science. This is again a very good company, very good promoter, and they have a good record also. But unfortunately, this was not even oversubscribed like Zomato and Tattva Chintan. It was only oversubscribed by 44 times. Issue price was 720 crores. Issue size was around 1500 crores. It got only listed of 750 rupees, which is a premium of only 30 rupees. It made a high of around 800, and currently it is traded at 750. This is a good company to buy at current level. One will, 1 year or down the line, 1 to 2 years, people will make a good money out of it. This is the face value of only 1. Devyani International IPO came at between 4 to 6th August. This is KFC and Pizza Hut franchisee. It was oversubscribed by 116 times. Issue price was 90 rupees. Total issue size was 1800 crores. Right now, yesterday I see a grey market premium of 55. So one can easily, even 50 rupees, person can earn easily 7,000-8,000 if it is allotted to investor. I don't think so. This is good company. This will never make profit, I believe, personally, because there are a lot of competition in this kind of industry. Krssna Diagnostics. This was also between 4 to 6 August. This is good company. Issue was oversubscribed by 64 times. Issue price was 954, and the issue price was around 1200 crores. It is also having the good grey market premium right now, about 300 rupees. Those who have got allotment will able to earn easily 4 to 5,000, any figure between 4 to 5,000. This is also a good company, and it will definitely have a good competition with Metropolis or Thyrocare or like these companies. Windlass Biotech also issue came between 4 to 6 August. I think this was relatively less marketed. So issue was only oversubscribed by 22 times. Issue price was 460. Issue size was also around 400 crores. It is right now a grey market. Premium is around rupees 85. And this is also a good company according to me. it will make a good progress in future. Exavotiles, Gujarat-based company, same issue came between 4th to 6th August. It was oversubscribed by around 22 times. Issue price was 120. And it was a very small issue size of 160 crores. Gray market premium is almost, I believe, nothing. It will open at the same 120 price because these all 4 companies will open on Monday or Tuesday probably. One company is opening on Tuesday, other 3 companies are opening on Monday now. So let's see what happens on Monday, Tuesday. The last week issues are, there were 4 issues last week came. Between 9 to 11th August, Car Trade Tech Limited, this car wale, bike wale kind of things. It was oversubscribed by 20 times. First 2 days, I've checked it, first 2 days, subscription was very badly. And, I was thinking this issue will not be able to subscribe. But somehow because of QIB and NII, they are able to oversubscribe by 20 times. Issue price is around 1600 and issue size is 3000. Nothing will come to the company. I don't think so. This anybody is getting any allotment should sell on the first day. This is my personal view. Nobody knows what will happen to this company. Like, it's a technology company, will do superb, or it may not do at all anything. It's about the side story. Nuvoco Vistas came IPO 9 to 11th August. It's a Nirma Group company, largest cement manufacturer and ready-mix concrete in northeast or north part of India. There are a lot of rumors about this company, that this company, one vendor has made a petition under insolvency. But I tried to find out in RHP contents, there are no details of any vendor has made any insolvency petition.
Interesting point. Hemant is there with us. Hemant?
You have to mute.
Yeah, Hemant is there with us.
Hello, sir.
He is a well-known, expert on insolvency. Hemant, can you mention about what are the implications of this?
Actually, if any company which is going at the stage of public issue only to insolvency, then definitely SEBI will take some strict action, and SEBI will not, either they will impose some penalty or something will be done. But I don't think that news is confirmed till the date. So we have to wait and watch.
But why the company has not come out with a denial?
In this matter.
But in such cases, the company is supposed to come out with a denial, no? It is being widely circulated. So either they should deny or they should confirm. It has raised lots of question marks.
If it is filed under insolvency, definitely one will come to know even from the NCLT side also. So I think so far as the news is not confirmed, so we cannot predict anything. But if such thing has happened, definitely SEBI is the authority who can take all the actions against the company, and they can withhold the IPO also.
How long does it take to come on the NCLT side after the petition is filed by an operational creditor?
Yeah, it takes around 20-25 days. But if you file a immediate, letter to register about the information under information and this thing, definitely you will come to know within 2-3 days or 7 days at the most.
Okay, so time will tell the website about this, whether it is factual or it is by a vested interest to cause uncertainty about the company.
But Manoj,
I can't understand why somebody will do some kind of things which is not true. Like, example, if you search in Google, this company that Ramesh Stone, something like that, they have very clear cut, they have said in like that we have sent letters to SEBI, Ministry of Commerce, Ministry of Finance, ROC, and stock exchanges against this issue. So if that party is doing, suppose the party is bogus, and if they are doing it, company definitely can take a legal action on it. So I don't think so any company which is a proprietorship can do such a wrong thing. It would be have a very big effect on that, on personal grounds basically. So there should, I think, and people say that there are a lot of people have sent emails to SEBI and SEBI has not even answered that. So
Manish bhai, what I understand is that this party has been trying from the company to recover his dues, something like 5 crores plus interest at 18%. So it comes around 6.5 crore. Now 6.5 crore is not a small amount for a small company or a SME kind of a supplier.
Correct.
And it's a frustration or a desperation which has made him go to the this NCLT for this IBC. So I think there is some substance in the story which doesn't show good on the part of the company as a corporate governance.
Correct. Company should have denied on the first day or before first day rather. And that is why this is the reason this was actually supposed to be a failed issue, but somehow because of QIB, if you see the retail portion is only 0.73 times. It's a very,
I saw that. On the second day, even on the third day up to 12 o'clock, it was around 0.7 or so.
Yes.
Because the issue has been saved by some parties.
Yeah, it's QIB basically. QIB has, put a lot of money between 2 o'clock to 3 o'clock. That is the reason. I have
a very good valuation on listing. Otherwise, it was an unlisted company. Now they'll have an advantage of listed company and also the tax benefits of a listed company.
So the only, Manoj bhai, a company group like Nirmas does like this is a very bad actually. They have a good.
We don't know whether Nirma has done or some party international has done this thing.
Because Nirma is the promoter है sir ये company. Hemant bhai.
You are coming to any public issue, so many people who are trying to play this kind of technique. Either some of them are trying to find out some sort of legal lacuna in the prospectus or statement in lieu of prospectus, whatever is there, and they are trying. In past, we have observed that many of the legal person who are already expert in this kind of thing, they try to blackmail the promoter on basis of this kind of thing. So we need to find out whether it is a actual dues or how it has gone. Because at
this is the first instance. But this is the first instance against any public issue, I believe. This kind of information never came before this, right?
Yes, but this is a new technique, no, boss. I did 3 years back, So earlier people used to, give in newspaper. These are the lacuna. Company has given this false information in the prospectus. This is not true, and this is the fact, like that. So that they are trying to, blackmail the promoter also. That we had seen past also. It has happened by many person who are expert in legal thing. Even in balance sheet also they have observed. They are trying to, blackmail the promoter that if you are not going to do this, definitely we will, publish this in newspaper, like that. So we need the fact, and then only we can come to some conclusion.
Yeah, let's the facts will come out. We'll see. We'll discuss in next meeting this what will happen to this. Shall we go ahead?
Yeah, go on. There are lots of companies.
Templa Sanmar. इसका भी बहुत न्यूज था.
लंबा पीस में नहीं है 60 रुपए किस चीज के, गोल के थोड़ा 60 रुपए मिलते हैं, तो फिर 60 का मांग रहे हैं.
इसका तो चालू है भाई. See, this company was actually delisted in 2012 at 5 rupees, some 45 paisas. I know I was also a shareholder that time. And now
I was also victim of this company.
Yeah, right, correct. This has come with a now issue price is around 540 rupees. This company was also last day. QIB put lot of money and public issues subscribe basically. I think this will not. This will definitely listed will be listed at below price. Definitely. Gray market premium is nothing. It will definitely listed at a very low price, and one will see around 500 price definitely on first day. This is my feeling. So this company is like that. Let us see. That's a question. I have seen SEBI regulations for delisting and listing, which would says that any company which was delisted in past can apply for listing again. There was no period mentioned. There is no cooling period. There is no time period. Nothing is there. As an investor, I think this is not good. But
incidentally, it is interesting. The name of the company is being retained. Normally, fly off by night promoters keep on changing, and here there's a talk about market cycle, and also how the indices reacted at that point of time, and now the different indices, and now the chemical sector is in flavor. And hats off to the smart investment bankers who have gone to the company and given the suggestion and have luckily successfully sold the IPO and gets it listing again. It's a hats off to the investment bankers.
There are certain guidelines so far as SEBI is concerned. So far as SEBI is concerned, there are certain guidelines, because I myself had seen one letter of delisting, wherein the one has to buy at the time of delisting. One is to buy, past 2 or 3 years average at average price. That is, the promoter has to buy it, and they have to delist the company by acquiring certain number of shares, minimum 95 or something. And after up to 3 or 5 years, they cannot come into public. They cannot come for listing as such. That is what if I remember, there is some number of years, but I can just check it out and then confirm.
Okay. Next issue was Aptus Value Housing Finance between 10 to 12 August. So this was also again subscribed at only 1.71 times. Issue price was 353 and issue size was 2,780. This company is mainly in the south three states, Andhra, Telangana, and Karnataka, and this Tamil Nadu. There's also gray market premium is very low, rupees 30. Maybe by listing day it will come down. Gray market premium will definitely come down because everybody will get a allotment. All retail portion is not at all, they're unable to sold to the retail people. If we see last week all the 4 public issues, because of this kind of information on various channels, WhatsApp group, retail investors have stayed away from this IPO, and this IPO they have able to subscribe because of QIB portion. So this is the reason that, and if you see there are next 2 or 3 weeks IPOs, lot of people have filed RHP, but अभी तक किसी का IPO आने वाले है, वो डेट अभी तक किसी की आई नहीं है. So we can say that people are now running away from IPO.
Yeah, one thing good is that retail category people have really understood the game, and I was so happy that this time these 4 issues where there are they looked high price and the retail category is not fully subscribed.
Correct.
Let the institution decide. But Manish bhai,
yeah, tell me.
आपका 2 स्लाइड में दिस QIB NII रिटेल वो पोर्शन सेम लगता है.
मैंने तो फिर कुछ गड़बड़ किया, बट दोनों का ऑलमोस्ट सेम हुआ था. आई मेड सम मिस्टेक. करेक्ट. बट नोवोका का हालत बहुत खराब था. तो नोवोको चैम्प्लास दोनों का figures were very low side. I made some mistake. Agree.
But both were at the low side. Yes, that's true.
Yeah. Thank you. आपने कुछ गलती निकाला.
गलती नहीं, I just observe किया. I was just looking at the numbers.
It's fine, sir. I will be taking more care in future.
Yeah, but it will be interesting to see how they are listed.
Definitely.
Yeah, and
तो इवन आपको ये मंडे ट्यूसडे दिखेगा लिस्टेड और नेक्स्ट मंडे ट्यूसडे भी देखिए सब चार कंपनी है 4 कंपनीज दिस वीक लिस्टिंग and 4 companies next week listing. It will be interesting to see the prices.
Yeah,
and that will decide the future IPOs.
Right. In case of this Nuvoco, in case of this card trade,
yeah,
their oversubscription is also a bit surprising to me in the sense that the company has made only profit 1 year and not much, just about I think 22 crores or something, and the issue was such a big size, 3,000 crore, and out of that I think 2,000 plus crores going to the promoter. So it's a tech company, but money is largely going to the promoter, unlike Zomato, where 9,000 crores went to the company.
See, that is the reason I tell you on Monday when I was looking at both Z Business and CNBC Awas, both the people were saying that the company अगर इतना ही अच्छा है, टेक्नोलॉजी सॉलिड है, इनके पास 600 करोड़ का कैश पड़ा है, कार ट्रेड के पास 600 करोड़ का कैश पड़ा है, then why promoter, instead of looking at their future, they are selling the stake and encashing it.
Correct.
So this is the reason why people have stayed away from these 4 IPOs. And I think that is why on Monday and Tuesday, market sentiment was also bad because of this public issue debate.
Yeah, let's see, because these 4 issues, at least the retail portion, and not that good a response. And overall, let's see now what happens in the market.
Correct. So can we move to something else?
Sure.
Manoj bhai, kya dekhna hai aapko? You want to see the vehicle scrap policy, or you want to see that those 2 companies?
We will do your Devyani International. You have the analysis. Okay. Then we'll do a scrappage policy also. First, we do the IPO analysis and IPO reviews complete.
Okay, done, sir. Yeah, you can see this Devyani International.
Yes.
See, we have actually already done this. But what I feel about this company, 2-3 things. This is basically
come to the earlier slide. You had something interesting. Come to the earlier slide.
This one?
Yeah, here you talked about the company promoters.
Yeah, this promoters is, this Varun Beverages promoters, they are the same family. And
yes. Yes, they have a good track record in running businesses and franchises.
Correct. They have a good track record of running this kind of businesses, definitely. Varun Beverage is the largest, Coca-Cola franchisee in India. Is the largest one. This company actually incorporated in 1991, and across they have around 655 stores. As on March 31, they have 3 main brands: Pizza Hut, KFC, and Yum brands. They have, this kind of businesses they have. They have a lot of other brands also, like Wango, Food Street, Masala Twist, Ile Bar, and Crush Juice Bar. The first Pizza Hut store was started in Jaipur, and subsequent they have expanded in other cities like that. They have a good competitive strength because they are well versed in this kind of business of running franchisee business. See, risk factors, I have added this slide. These are the risk factors because first risk factor is COVID. As on date, we don't know when this all fully we will recover from COVID effect. So till that, I think company will not be able to make any profits. If you see RHP says company have incurred losses in fiscals 2019, 20, 21, resulting in erosion of net worth. So इसका net worth भी नहीं है, लेकिन हमारे पास 90 रुपया मांग रहा है वो.
This is a very important analysis you have brought out as a risk factor, where you have quoted uh, the report of the auditors also, which talks about material uncertainty and doubt about the ability to continue as a going concern. It's a key area which is required to be mandatorily mentioned in the audit report now. Earlier, they were not mentioning in the main audit report. They were just talking in the notes, which people usually hardly read. But of course, you and other participants do a deep dive review and they come out with such things.
And see, their net worth is negative. Their current liability is more than the current assets. So that is why auditor says that these conditions indicate the existence of material uncertainty that may cast significant doubt about the group and its joint ventures' ability to continue as a going concern. So I am sure. I think now, see, this is the reason I believe that now people are staying away from IPOs actually. Because,
even in Vodafone Idea, such comments are not there.
Correct. Correct.
So why it is pricing? That is a question mark. Is it a brand value and market hype?
Correct.
A number of times due to liquidity provided by NBFCs.
Second thing, company says, I think this is very important because they are, they are using a global brands. So any negative impact on global brands will affect the business in India. I think this is also a very big risk factor because they have a 2-3 very big brands, and if one brand makes there is a problem in one brand, their business will affect very big way. Their RHP says that there are some delays and default in payment of statutory dues of company. So I believe any company which is not even able to pay statutory dues, there is really a serious issues are there.
This is a very serious issue. Next time you should mention the page number or the RHP. It's very, very important thing.
Sure. Very good suggestion actually. And that this is one more issue for risk factor for the investor, specifically a retail investor. That company have issued equity shares at a price that may be lower than offer price in last 12 months. They have, to the promoter group, they have issued at only 43 rupees, and they are offering public at 90 rupees, so almost double the rate. Of course, this is not a risk factor, but this is risk factor for the retail investor side, not from QIB, not from promoter.
And the anchors are ready to pay double the price because they feel 1 out of 10 may go wrong, 9 may go right, but why not pay at the asking price?
Correct. पहले भी ये slides था. These are the competitors: Domino's, Starbucks, Subway, McDonald's, Burger King. As we know, Subway is now bought by Reliance, right? So it will give a very big competition to other competitors.
And actually, you should mention Jubilant effectively, directly. Jubilant is a listed. Yeah, that is one of the brands. Now they are diversified into several franchises.
Okay.
So Jubilant and Burger King are listed competitors.
Correct. RHP.
Direct competitors, but in the same franchise model.
Okay, correct. Great.
Varun Beverages also, if you consider FNBC sector and QSR sector.
Correct.
And McDonald's also, the listed company name is there.
नहीं सर, मैकडोनल्ड्स का जो बिजनेस है ना वो लिस्टेड नहीं है, उसकी जो एक पेरेंट कंपनी है ना वो लिस्टेड है.
No, there is a franchise which is listed West.
सर वेस्ट लाइफ वाला जो है ना सर, उसके अंदर शायद ये बिजनेस नहीं है. That is what I understand.
It is there.
Okay. Yeah. Correct. The financials say that they have made a loss last 3 years. Their net asset value is 0.65 rupees. 0.65 rupees, मतलब 65 पैसा है per share. Borrowing is around 463 crores. Business-wise revenue, this all we have seen actually.
Yeah, they mentioned, you see, in the peer review, they mentioned Jubilant and Westlife. And
yeah, Westlife. Correct, sir, correct. I was wrong in that. Westlife.
So the lowest NAV per share.
But I tell you one thing, Westlife as a business, जो actually McDonald's के लिए सारा जो भी stores होता है ना, उसका भी they are erecting all stores also. Whereas this KFC and all, they do it. This opening of new stores, that work is done by outside people. Whereas in case of McDonald's, I think Westlife itself does that work. That is the reason.
And Devyani has tweaked his business model also recently from large store formats for Pizza Hut to smaller store formats because of the learnings from the pandemic.
Correct.
And reduced the loss per store budgeted and due to a low occupancy and the delivery model.
Correct. We know that 77% money of IP will go to the promoters.
Although the company needs a huge money, to beef up its net worth. So there is no going concern risk. So why not a larger part of the money should go to the fund, to the company?
That should have happened actually, because I believe that out of 1800, they are getting some 500 odd figures the company will get, right? And I think
they could have increased the size.
50% they will pay.
Manish,
50% they will pay.
Manish, the question here is that out of 18 crores, the promoter will get 1400 so 1398, right? So something like 440 crore may go to the company, and company has a 4600 crore debt. So hardly 400 crores will be used there. So company's position is not going to improve much.
Definitely not, sir.
Yeah,
and आपको मैं बोलता हूँ कि because of this corona, another 6 months will not be so good.
No, but then it's a bumper earning for the promoters. And Manoj ji, if you can, if you have any idea about any SEBI rule which can limit the promoter part in any public issue.
Well, the RHP, draft RHP is filed and it is approved, it is cleared. And ultimately, nowadays IPO pricings are decided by anchor investors who have more access to the information on their business and financial models about the future.
Yeah,
which,
but somewhere,
many investors, even savvy investors, they don't have access to it.
Yeah, but then see issues like car trade and Devyani and all, where promoter go with a larger chunk and the company is not profitable at all. Whatever business model they have developed, yes, right. Whatever struggle or hard work they have done, all appreciated. But ultimately, at the end of the day, you look at the financials, and when the financials are not so good, then how much promoter can raise money from the loss-making company.
But financials are often improving because of the investment, sometimes in unlisted place. Now they are listed place. So there is an exit and new people, promoters to come in, and they are supposed to do their own due diligence. Yeah. Hopefully read the RHP in detail, and who don't get time to read RHP, they can at least go through the discussions and risk factors which are coming out in slides so excellently brought out by Manish.
Yeah, Manish is doing a good job. What I'm saying is that somewhere I think this public issue part, earlier the rule was that no company can come out with a public issue unless they are profitable and things like that. Now those things would have protected at least retailers. Now retailers also are greedy, and they are, I would say, I don't know, knowingly, unknowingly, they may be falling in this lure.
But the many times globally in the last 10 years, investors internationally are making more money by investing in long-term wealth creation in loss-making companies than companies having good book values where governance and promoter quality is very poor, and auditors are also overlooking it, and people are losing money. So it's a market dynamics one needs to understand and continue looking at the data points coming of investors, various classes after these companies get listed.
Yeah, true.
And promoters have their own needs. Maybe they had done borrowings for promoting enterprises and coming out with successful brands. Maybe they need to pay off the borrowings and restructure their own finances because they have created successful brands. And hopefully in the future, company capitalization would improve. But we just hope the investors don't lose money by investing blindly in the brands and investing just by the hype and the number of times anchors or QIP or HNI investors are doing because of leverage. So these IPO openers are there, and these points raised are very, very material and very important. And this shows the type of deep dive which is being done on the various issues in the RHP and beyond RHP also.
You know, Dushan Bhai, there was one company last month, GR Infra Projects.
Right.
They came out with 100% money taken by promoter. I saw his interview on Z Business. He told very clear cut on the TV channel that we are coming out of public issue for specifically listing the company. We have enough cash, enough business. So, and you know that everybody earn money. Like I think
yeah, but
it was listed at double the price.
If it's a profit-making company, you know, then it's fine. Here, loss-making means at the retail level, people are not that matured enough, and you know, won't understand this long-term plays. That's what my point.
Correct. You are what you say. I am 100% agree with you, and I also fear, okay, people will, you know, there will be a break to the public issue now. There are 2-3 things SEBI should now check into. This that at least 50% money should go to the company.
That's what I'm saying. There has to be some limit to the promoter, you know, money going to the promoter.
Correct. This is nothing
but a suggestion you are given, at least 50%. That's a very good suggestion you are given. I would say
2/3. It should be at least 2/3 to the company, not even 50. 2/3, 50 is also less. Say like Zomato, they could have done it, but in case of Zomato, only 375 crore went to the promoter and 9,000 crore went to the company. So that I appreciate.
Yes.
Good points raised.
So this was the, let's see that how much price they open on Monday.
Yes.
Now. So can we move to another company?
Yeah, there are lots of suggestions coming to do now all the sectors. There are 20 sectors and do sectoral analysis one by one, initially on the important sectors and then move. So this scrappage policy is part of a sub-analysis for the impact it will have on the not only the auto but the steel sector also. It's a kind of a independence pre-Independence Day announcement which the government has done, which they said it will create a lot of employment. And what is the real story behind it? The opportunities and the limitations. So we will know it's a part of a sectoral analysis deep dive.
So this is good. Actually, yesterday I spent around 2-3 hours preparing these slides, and I like this. This is very good. I have seen some other kind of things where on internet I searched that what other companies doing or what other countries doing. Simple. I spent yesterday 3 hours, and I know Manoj Bhai sent me a mail, SMS, or a WhatsApp message when you are sending this particular presentation, right, Manoj Bhai?
The best thing about you is the best thing about you wearing the ThinkTank hat is to cover the latest and developments with a deep dive approach, and you are doing it once again.
I saw your message after I sent you the slides at around 11 o'clock. So it's okay. It's maybe
24/7/365 is the global approach to dynamic markets.
Yeah, Manish, I tell you, this business is very
Manish,
good. Huh?
Clap for Manish.
Thank you, sir. Thank you. See, these features are very common. These policies, I think, voluntary is still there, but now the government is making, they are shifting this industry from unorganized sector to the organized sector by inviting corporate companies, and mostly I believe that a lot of automobile companies will invest in this business. So in turn, they will get raw material at cheaper prices and they will be able to sell more vehicle. Let us go through the features. This policy is simply, they are giving incentives to the owners of old and polluting vehicles to take them off the road and scrap them. Vehicles in the very first phase, whenever government is owning any kind of vehicles which are 15 years and over, they will start scrapping them first. From 2023 onwards, heavy commercial vehicles will be scrapped if they do not confirm any fitness level. And for personal vehicles, this will be start from FY 2022 onwards. In a nutshell, commercial vehicles that are over 15 years old and personal vehicles that are over 20 years old will become eligible for scrapping. They will give some incentives when you scrap your old vehicles and you buy your new vehicles, like they will give a rebate on road tax up to 25% on passenger vehicles and 15% on commercial vehicles. They are also now insisting that automobile manufacturer also should give a 5% discount on buying new vehicles when somebody is giving a buyback of scrap vehicles. The government, expects to generate employment of around 35,000 people at a vehicle fitness centers and scrapyards and a collective investment of 10,000 crores. Every vehicle after 15 years or 20 years, whatever, they have to go for the fitness test, and it will cost them around 300 and 400 to 1,000 to 15,000 depending on the types of vehicles. But real consumers like us, we have to wait for another 2-3 years, because first they will go for a government-owned vehicles only. There is a lot of opportunities in this field because new scrappage yard and testing facilities will come up to check the roadworthiness, and it has to be, set up across the country. And as per ministry's database, around 1 crore vehicle as on date doesn't have any fitness certificate. They are running on the roads without any papers, any authenticity. So they see that these vehicles will come out for a scrapping. Right now, India's vehicle scrapping industry is highly unorganized and controlled mostly by roadside garage owners. The scrapping process is labor intensive and largely done manually. So I would say this is a clear-cut shifting from unorganized sector to somehow organized sector, and from labor intensive to machine oriented industry. This shifting will happen by 5 to 10 years, I believe. So, and also the ministry hopes that this scheme will also address the availability of key raw materials like rare earths and metals. About 60 vehicle scrap centers will be set up by private sector with the help of state government. So even 60 vehicle scrap centers are very less, because we have almost 30 states. Even 2, so average is only 2 scrap centers are also very less. So it is, and government also needs a more time to set up a vehicle testing facility and scrapyard before private cars can become eligible for incentive. Now comes opportunity. Vehicle scrapping is expected to become a thriving business in the coming years. Hence, most automakers are interested, and the number of old vehicles, especially commercial vehicles, is staggering. So the potential is huge. most automakers are expected to tie up with some other company to get the technology involved in scrapping of vehicles. This policy will help companies like Ashok Leyland, Tata Motors, Maruti, and other big auto companies who specifically manufactures four-wheelers and commercial vehicles. At the same time, they also have to invest a very big amount in erecting scrapping facility either through their own companies or through joint ventures. The benefit is they will get a raw material at cheap rate which can be recycled. I have one slide what kind of raw materials they will get it from the scrapping of vehicles. Even if you see two-wheeler companies like Hero Honda, Bajaj, Eicher, etc., they also can be benefited from this, but same time they have to invest in scrapping facility. This is the worldwide scenario.
Expecting companies like MSTC also to benefit in a big time.
I have one slide there. I have one slide. Manoj bhai, uske liye acha hai. Wo, that is first company who is putting one plant. This is the worldwide scenario. Like USA is doing 12-15 million car scrap per year. You know, they get a business of 22 billion US dollars. Same way Europe, Japan, China, Canada. Right now we are doing only 3-4 million. So 30-40 lakhs cars or vehicles, I would say. Suppose if we also do 15-20 millions, which is a 2 crore per year, so there will be a very big industry will come up in India of, we can call it a scrap industry, right? And we will have a stock market also. We have one area called a scrapping companies like banking and financials. See, this is the components of scrap. What they say that what they get when a vehicle is being scrapped, they get a steel scrap of 65 to 70%. Aluminium they get 7-8%. Copper they get around 1 to 2%, and rubber and plastics they get around 15-20%. What I read somewhere that one car or one vehicle is around 1500 kg weight, out of which they get all these things. And all these 4 items, steel, aluminum, copper, rubber, plastics, everything is recyclable. So if we start recycle this, there will be,
Manish, where did you get this data of 31,000 rupees? It is for a small car, or what is the size and what is the source of this data?
Sir, एक website था, I forgot the name. इसके ऊपर ये 2-3 slide रखा था. What they say कि right now you sell your car, तो 5-10 हजार रुपया मिलता है. But if this scrapping facilities will come, basically, a person will get approximately 30-35,000 per vehicle. This is just an estimation. So, but it's a good analysis that at least we know that a vehicle contains what is steel, what is aluminum, what is copper, and what is other item. Right now, I'm not going on
rising value of scrap and steel. Rising value of steel prices. The scrap prices are also going up, and this is good value benchmark which is given.
Correct.
So if people get this kind of prices and bigger cars get higher prices, of course, it will help a replacement and also a big kickstart to the auto sector. And scrap-based mini steel plants, many of them have been closed.
Correct.
They can think of reopening and generating employment, and with the use of new technology coming.
See, this is that MSTC plant. They are coming to one plant in Kandla, Gujarat, with an investment of 1.2 billion, with a 40 tons capacity per hour. The shredding unit will be built near Kandla in Gujarat. The plant will have a capacity of 40 tons per hour and will require an investment of 1.2 billion. Various collection centers will be set up all across the nation, from where they will be sent to the plant for shredding. MSTC has put out a form inviting consumers to list their vehicles and white goods for shredding and get quotes for the same. The project will take 1-2 years for completion. So this is one more thing that wherever ports are there, like Mumbai is there, Visakhapatnam is there, Paradip is there, even in West Bengal, I think this kind of facilities can come up in each and every state possibly. Because I personally feel movement from one state to another with the scrap vehicles, there will be a lot of logistics cost which would be involved. But if it is traveling, it will be a transport from in the same state, it would be a easy task. Because we have to also see the GST implication of purchase of scrap vehicles from the consumers, and then again selling off all this metals to the companies. See, this is one company, Mahindra Steel. One company is already in existence. They actually buy vehicles, and Mahindra and Mahindra has a joint venture with MSTC in this company, where Mahindra buy back the scrap vehicles and give it to CO company. And if you see this, CO company does a vehicle evaluation. They arrange quote for exchange, scrapping value of the vehicles, provide end-to-end services including vehicle pickup, transportation, and they actually give you a certificate of deposit or destruction for your vehicle. So this certificate of destruction is the main point where in future a person is eligible to get the benefits under scrappage policy. I have, I know this company. When I have inquired, they have one scrap yard in Pune and another scrap yard they have put it in Noida. And Noida, they have a full-fledged capacity to break the all vehicles. I have seen this company. And Tata Motors have also announced that they will start with 4 units, but later on they may plan to expand the scrapping business. Maruti Suzuki also announced a tie-up with Toyota Motors for setting up a vehicle dismantling units across the country car. So I believe that all these big automobile manufacturers like Tata Motors, Maruti, Mahindra and Mahindra, Hyundai, eventually everyone will come up with some tie-up, some joint venture for dismantling their own vehicles, which they will buy back against a new vehicles. So definitely whosoever is holding old vehicles, and if they go for buyback, they will get a better price in future down the line 1 to 2 years. This is that small presentation on a vehicle scrappage policy announced yesterday. Anybody having any question, let us have a discussion because this is new for me also.
Yeah, Manish, I think you have given a good coverage in a very short time. And the contours are of this scrappage policy and how the people at large are really taking it will be known maybe in the due course. But it was anyway discussed for last 2 years. And I thought that some point of time Mr. Nitin Gadkari will announce, and it was announced day before by Prime Minister. The thing is, one point that the scrappage policy, when all these automakers, they either connect with some agencies or they set up their own scrappage plants. Suppose I have got say, Centro car. Will it be necessary I go to Hyundai only, or I can go to Tata, or I can go to Maruti with my Centro car? I mean, whether scrappage company will not have any problem about any company car.
Yeah, there won't be any problem such that. But if you go for it's a pure commercial kind of things. Like if you have a Hyundai car and if you go to Tata may give you a 20% less probably. But if you go to Hyundai, they will give a good price. That can be only reason.
Yeah, that may happen that they may give something more.
They are talking about scrapping testing centers. So there may be separate agencies which may be doing it, and some of these biggies, they connect their marketing plans with the buyback plans or exchange offers. So they may offer some incentives, but this independent centers, agencies for testing, which they have said independent agencies will be happen. That is quite interesting, and people are linking it with the development of the steel sector also. So as Dushyant said, 3 years, it was a big waiting game. When is it coming? When is it coming? It has come. Now one has to look at the timelines. Manish, you have looked at the timelines, no? When it will start happening and when it will come in full force.
I tell you, if companies like, see, right, companies like Tata, Maruti, Mahindra, if they take interest, so definitely this passenger vehicles will start, churning out old and new vehicles. Same way, the companies like Eicher or Ashok Leyland, or companies like small companies like SML Isuzu, who are into a production of commercial vehicles. If those people take, some kind of interest, definitely, at least on private sector size, this will start. As we know, government saying that we will do first of our vehicles, which looks little bit. There can be some delay, but private sector, I believe it will start in next 6 to 12 months in a big way.
So you will be seeing many new vehicles on the roads and a big impetus toward New India, right?
Because it's ultimately for a company, this will become a marketing funda that you bring my own car, I will give you more money and I will give you more discount on new vehicles.
With multiple fuel options, whether it is ethanol based or gas based or EV based, charging point based.
Correct, exactly. So, and I would say new kind of industries will come up in India. Maybe a very small industry, but in future, even we will import old cars from Americas and Dubai, and then we will scrap like what is right now happening in Alang yard, that they bring up very old ships and they break it. In fact, yesterday there was one vehicle scrap facility has come up in Alang, along with this policy announcement. And
so India growth story gets a major boost.
Let's see how it is. Correct.
Great, wonderful presentation. Good deep dive into the sectors, the government policy based, and hope we'll have many more sectoral analysis. I think you are planning a sector analysis of refining and petroleum sector. Look at all the companies, including large diversified companies also, who are leaders. So we'll have a sector analysis series soon, sector by sector, with deep dive, with practical example of real life stories and benchmarks with India and abroad.
Correct.
Great. Anything else from anybody? It's really a wonderful session.
So Manish bhai, a very nice presentation overall.
Thank you.
And we will see what happens in the market next week.
Dushyant, yes. Remarks from you on all the discussions, presentations, as usual. Dushyant, some concluding remarks from you before the final sign-off?
The sessions went up very well. PMS, I thought it was a good quant concept which was brought to us. It was, personally, I feel when you are doing investment yourself, then you find difficulty selecting companies, because how many companies individually you can review or you can think of investing. So this kind of approach also is a good option available now to the investors, which they explained nicely. And that way derivative session by Shilpa was very good, very informative, very practical. and it was worth, you can use it like, kind of a concept that you can put to use as soon as you can. And Manish has covered the public issues, the aftermath of the public issues, and this scrapping policy, which is also very important. So today, all the topics covered were very interesting. So great going, Manoj.
Wonderful 4 hours marathon session with deep dive and latest developments well covered. With yesterday's data from NSE and yesterday's policy also from the Prime Minister. So happy Independence Day to all.
Yes, happy
And,
Independence.
Yes, happy Independence Day to everybody.
And we look forward to great listing, more IPOs, more IPO reviews, and more policy reviews, more sectoral analysis with regular outlook.
And Manish, for the
Yes,
record's sake, these Devyani and all those XRO and all the 4 issues I applied in the name of each and every family member.
Yes.
But not a single allotment.
I applied 5 into 4, 20 applications, and I got only 1 XRO.
Yeah, I applied 15. And
No,
I got 0.
I made a mistake. I tell you, I never bought shares of who is a leaker company, and never bought a shares of even Jubilant Food because they serve non-veg. First time I applied for Devyani, and after applying 2 days, somebody told me you should not apply, and I thought, God, don't give me allotment, though the highest premium was there. So it's a personal view, nothing like it.
Yeah.
So.
And once again, Manish, just repeat a disclaimer.
Yeah. See, I hold.
Show a slide.
Like this is the disclaimer. I and Dushan Bhai both said that we have applied and we got allotment. So, but I tell you, whatever actually I do analysis of companies like I today, Manoj Bhai, आपको मालूम है, मैंने वो BPCL, HPCL, IOC का एक comparative analysis बनाया था, which will be discussed whenever we want to discuss.
As a part of a sectoral analysis review.
Correct. I also prepared 2 analysis, one on the company of Sharda Motor Industries and Tide Water Oil. But
we will take it in future. We will take it in
next time
when we cover.
Definitely, whenever you say, there is no issue. But I generally, because all these companies, I go quarter to quarter study. So and I own these shares basically. So this is my disclaimer.
Keep on doing listing reviews. And always, as we say, consult your own investment advisor, stockbroker, investment banker for any transaction.
And I tell you one good benefit, Manoj Bhai, Dushan Bhai, RHP पढ़ने को आ गया अभी. ये इतना 7-8 issue करने से.
Everybody should read. It is a very good extract for the RHP you are doing. Everybody should read the RHP and the slides coming from RHP.
Yeah, RHP size also SEBI should limit here. Going into 450 pages and all is too much.
No, sir. Dushan Bhai, I tell you my personal view. आप अगर क्या एक बेनिफिट ये होता है RHP पढ़ने से कि we able to get understanding of that particular industry also. That is the benefit. It takes around 3 to 4 hours altogether. मैं 4 घंटा एक RHP पढ़ने में लगाता हूँ. So this is my experience I'm sharing with you.
Understanding the RHP has become an art and science both, and making a précis and to communicate also. It's really wonderful how in such a short period so many things are coming out, and which investors never know or would never know in future also. The type of defaults the company has done, the type of comments in the auditor's report, the key issues. Thanks to Milan, who has been really persisting and to come out with regular capital market sessions and coordinating. So heads off. So shall we close the session with happy Independence Day to all and good listing reviews again? Yes. And I hope investors do their manager risk very, very well before investing.
Yes, sir.
And look at RHP and the RHP reviews.
Yeah.
Before investing or after investing, don't ignore the RHP. Don't ignore the risk factors and don't ignore the
Correct.
disclaimers
Correct.
Right.
for
Okay,
educational
bye.
purpose, right?
Yeah, so
Bye.
happy
And
Indian
awareness
Financial to
purpose.
everyone.